viewers is out somewhere in 23 or late 22, a Fed waiting and waiting and waiting, and then the market's going to react to it. What do you anticipate?
Well, there'll be numerous tests of the Fed that the Fed will have to reply to over time. And you'll want to ask Rich Clarida whether he still believes, I'm sure he does, in this idea of a new neutral, the new neutral thesis that he helped develop at PIMCO in 2014. The new neutral means the Fed thinks that the neutral policy rate is lower today than it used to be. In the past, it might have been, call it 3% or so, or even 4%. Today it's probably in the low 2s. And so we want to know if the Fed still believes that. And the tests will come frequently, because when the inflation rate does, if it ever does get back up to the level the Fed wants, low 2s on the PCE, the markets will test the Fed to see if it will react to it, because the markets will be worried about inflation. That's where those other two components will require a different sort of policeman on the inflation beat. The bond vigilante might come back, as you saw recently. So those periods, like we've seen recently, will return now and then. But in the end, the inflation rate probably won't rise materially. That's our belief. And nor will the federal funds rate, call it somewhere in the 2s, most likely. But that test is yet to come.
So in your mind, Tony, nothing about this pandemic has changed the trajectory of the economy going into the pandemic. In the next couple of years, we'll be back to normal.
Well, in the U.S., we're expecting about 7% growth this year. We call it 3% next year, and the growth will be the best in 40 years.
Yeah.
But there are aspects of growth in this coming decade. You could say there's a transformation underway. It'll be more digital, more inclusive, and more green. So it'll be a very different sort of economy. You see this benefiting, for example, the semiconductor industry. Semiconductors will be a component of the green economy. Think of a charging station for electric vehicle requires semiconductors. Cars these days require more semiconductors. So there'll be a transformation, and it'll be more focused on the true drivers of growth: investments in people and in things, capital. Those are the major drivers, along with, of course, total factor productivity, how we use people's skills, how we use the things in place. So there is a major transformation underway that could mean faster growth. When we think it may mean about a 0.2 or so gain in GDP this decade relative to last, simply because we're investing in people and in things. But whether that leads to meaningfully more inflation, we would doubt it right now.
Tony, good to see you. As always, Tony Crescenzi there.
Thanks,
PIMCO
Tom.
Portfolio Manager and Market Strategist. Tom, at the heart of that conversation is the shift over at the Fed that we've talked about many times. A shift from a forecast-driven Fed to an outcome-driven Fed. And I'm not sure that we've fully got our hands around this yet. Is that a commitment to being late? A commitment to being late after decades of being too early?
Well, some of it's too early, but what I would suggest is not later, but the nuance of later, of lagging behind a little bit more. Are they going to react when they see data? Are they going to react immediately when they see data? Are they going to wait 1 meeting, 2 meetings, 3 meetings, et cetera? And this clearly is a Fed that wants to extend out.
Really loose state contingent forward guidance, and we start holding on to silly words like a string. Did you hear the chairman yesterday? A string of the payroll reports that we saw last Friday. We need to see a string of them, Tom.
Yeah, that's called a moving average.
What's a string?
Okay, that's called a 3-month moving average. I mean, you know, frankly, Hatzius at Goldman Sachs, when he was working for Dudley and McKelvey, was brilliant on this. I mean, it's called a moving average. You got to see some data, and I'll cut him some slack on data. But given the oddity of where we are, John, they just want to wait and wait and wait, and that's the bet in the market right now.
On the long wait, we'll catch up with Richard Clarida, the Federal Reserve Vice Chairman, a little bit later this morning on this program from New York City this morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Brambett's back with us on Monday. Your equity market looks like this. All-time highs on the S&P 500, pushing 4,100 on the S&P, up 0.1%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Most coronavirus vaccines are going to the wealthiest countries. So far, 40% of the COVID vaccines administered globally have gone to people in 27 wealthy nations that represent 11% of the population. That's according to the Bloomberg Vaccine Tracker. Countries making up the least wealthy 11% have gotten just 1.6% of the vaccines. In other words, countries with the highest incomes are vaccinating 25 times faster than those with the lowest. Federal Reserve Chairman Jerome Powell is pledging to get the U.S. back to a great economy. Speaking to a virtual panel, he said that he drives by a tent city for the homeless on his commute. And that reminds him that millions of Americans are still trying to find jobs. Powell also downplayed the prospects of inflation. President Biden's first Pentagon budget will be a decrease from Trump-era spending trend. Bloomberg's learned the president will seek $715 billion for the military. That amounts to a small decrease. Once inflation is factored in, the White House will be able to present that as a compromise to the Democrats who want to cut defense spending. And Amazon has taken a commanding lead in a historic election. The vote will determine whether workers at an Amazon warehouse in Alabama will become the first in the U.S. to join a retail union. With about half the votes counted, Amazon is ahead by a 2-to-1 margin. The retail, wholesale, and department store union calls the system broken and says it will appeal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
In the
United States, there is now a lot of discussion about infrastructure, including green infrastructure. Adding to this two elements, green and social services is social infrastructure is positive. Broadly speaking, yes, we do support it.
That was the IMF Managing Director on the U.S. infrastructure plan from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Brambett's back with us on Monday. Let's get straight to the price action. What a week it's been for the NASDAQ. The NASDAQ 100 up on a week by more than 3%. The Russell down on the week by about 0.5%. That's where the story has been. Right now, the S&P 500 futures up around about 3 points. A mild move higher, up 0.1% at 40.92 right now. Your high of the session, we had a little look at 4,100 on the S&P 500 a little bit early this morning. Just unreal, Tom. In the middle of all of this, yields up 5 basis points on 10s, 167 in a couple of hours' time. We'll catch up with the Vice Chairman of the Federal Reserve, Tom, Rich Clarida, just a few hours away.
Richard Clarida on where the Fed is. Transitory is what John's focused on, and I want to talk to him about some of the broader pictures of his science of monetary policy. Right now on the Science of Washington, and what is certain and known is you always have to read the most current book in Washington. Emily Wilkins this weekend will disappear, and she'll get through the first 2/3 of John Boehner's new book on the House. Speaker Boehner out with a tell-all. And it's fascinating, Emily, in your world, how John Boehner says he is a hostage. Within the infrastructure bill, how are the Republicans hostage to their clear and present?
So for Republicans on this current infrastructure bill, I mean, they do have to face the reality that Democrats can go at this alone. It's not easy to get all 50 Democratic senators on board for a package that's this large, but it is possible. And they have to realize sort of that Democrats can basically maneuver without them. And so there's sort of these dual incentives on the Republican side. Number one, to compromise with Democrats and get things done, be able to have some sort of say in this legislation. But on the other hand, there is a sense that if Democrats can pass things that Republicans know that they won't agree with, such as President Biden's tax plan, maybe the best thing to do is just to oppose it all from the start, which we've certainly seen from a number of lawmakers.
Who is the GDP Joe Manchin? I mean, Manchin's the Democrat from West Virginia. We all get the ballet. Is there an equivalent in the Republican Party?
I mean, I think when you do look at the Republican Party, it's only after Joe Manchin says no on something, then we all shift to the Republican Party and see if there's any Republican who's willing to join with Democrats to potentially get them to that 50-vote threshold. But I think particularly for legislation like this, that's really going to go through a long and extended negotiation process that's going to take months and months to put together, you're going to see sort of the opportunity for lawmakers to let it be known to leadership and the White House what they want to see in this bill, where their red lines are, and you are going to see them want to come together on this particular one, because frankly, whenever a Democrat votes with Republicans against one of these packages, like we saw in the House, you see Republicans pounce as say the opposition's bipartisan. Democrats don't like this either, even though it was just one lawmaker.
Emily, does the president have any interest working with Republicans right now? His campaign was about uniting things and working together again. We're looking at a majority in the House of what, 6 seats? In the Senate, it's a 50-50 split. There's many people talking about whether this administration even has a mandate to do the big changes they're trying to push through. What's that conversation sound like in Washington now?
I mean, I definitely think that there are bipartisan discussions and bipartisan outreach in Washington, D.C., but I think also at the same point behind the scenes, Democrats know that they have the power, that they're able to run things, and that they don't necessarily need to compromise with Republicans. At the same point, outside of the D.C. bubble, we've seen President Biden go ahead and start pitching this plan right to the American people. And I think we're going to see something similar what we saw with the $1.9 trillion COVID package, where no, you didn't see any federal level Republicans come out in support of it, but you saw Republican state and Republican local officials come out and say, yes, this bill is going to be positive for us. I think President Biden is hoping to get a similar dynamic with this upcoming infrastructure package.
The previous bill had a simple and compelling message. It was about a K-shaped recovery, and the bottom leg of the K needed some relief, Emily. It made sense. It was easy to understand. This time around, the president's talking about China eating our lunch. At the same time, he's talking about the middle class being fleeced. Secretary Yellen is going around talking about a global minimum corporate tax tax rate. There's other senators within the party talking about redefining what infrastructure spending actually is. Do you have any idea what the most compelling part of this effort actually is? If we had to boil it down to one thing, what is it actually?
I think the White House would probably tell you that the effort is about making sure that America has a full recovery after being in this pandemic, that the last bill that passed was sort of to stop the bleeding and get us to a place where we were stable, and this one's supposed to take us back to the place we were pre-pandemic and then even past that. So I think, but to use that, you are going to see a bunch of different messages. I mean, I think it's notable that you mentioned China. That's something that has a lot of bipartisan support in Washington right now. You just saw this major piece of bipartisan legislation how to handle China. And so I think by the Biden administration using that, that's part of how they're trying to appeal to Republicans here.
Emily, what's the agenda next week? What is the Emily Wilkins agenda in Washington next week?
So we're going to see a number of different things. We just some regular legislation that's being passed. But look, next week is the first time that lawmakers are back in D.C. since President Biden introduced this infrastructure plan. And so you're going to start to see rubber meeting the road on that as lawmakers get back to Washington or actually in the same rooms again and can negotiate. At the same point, big news today, President Biden is going to be spending a smaller budget to Congress. And that's going to sort of propose some of the initiatives that they want to see in the next year. And that's something we're also going to expect to see lawmakers start to work on.
Emily, get some rest. Enjoy the weekend. It's got to catch up. Emily Wilkins there of Bloomberg Government down in Washington, D.C., waking up early for us. Tom, let's just return to that point. This message from this administration has been so muddled. I don't think that the former Secretary, Larry Summers, helped this administration very much with the Laugh Relief Plan. He really muddied the waters. But it was a simple and compelling message that we needed to do more. This time around, it is so muddled, Tom. I find it really difficult. If you had to boil down what the infrastructure plan was really about, what the objective of it was, can you do that in one line?
No, you can't do it in 1,500 pages either. I mean, it is, but it's what you see in the first term of a new government. You see an all-in bill. This is, sort of an American tradition. The question is, what do they peel away like the onion? What do they peel away in terms of programs? And John, really, what does that number get down to? Does it get down to a convenient 1.9 trillion, which is not as big as 2.0 trillion?
Well, the corporate tax rate, for one, might not be 28, maybe it's 25. And maybe then the spending has to come down too, Tom. I don't think anyone thinks it ends up like it is right now at 28% at 2.25 trillion. I think we also have to remember the stakes at play here. These are high stakes. We're in a situation right now where we're talking about political systems. And what is the most effective political system? Is it the authoritarian regime over in China right now, centrally planned, or the democratic effort here in the United States, a democratic regime to get things done? And that's what the president's up against right now, to prove that this system can work and be effective for things like infrastructure spending. And so far, not so good over the last 10 years, and that's a great shame.
And critically, his thrust is to go back to something traditional, which is an allies structure. And are the allies on the same page? For example, with corporate tax rollout yesterday, Pascal Donohoe of Ireland said, maybe not.
Yeah, for good reason. And we know why.
Maybe.
Yeah.
Maybe not.
Yeah, good luck with that. Equity futures.
Let's have a Guinness.
Up a single point on the S&P. I'll take a Guinness right now, Tom.
I'm shocked.
Is it too early?
Excuse me, that's a surveillance break exclusive. Pharaoh needs a Guinness.
This is Bloomberg.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City this morning, good morning to you all. Let's do the story of the session and the story of the month. Story of the month is a NASDAQ comeback. Story of the session, something a little bit different. NASDAQ 100 futures come in about 0.25%. The S&P 500 pretty much unchanged. The Russell outperforming on a relative basis, up a little more than 0.1%. If you switch up the board, it's the story of the month. Compare it to the story of the session. The NASDAQ just with massive outperformance over the last month. This over the last 30 days, if you switch up the board, you'll see the NASDAQ outperformance up by 5.8%. The Russell down by 0.1%. Tommy, if you take it back to the March 8th low for the NASDAQ 100, we've ripped about 12 percentage points so far on the NASDAQ and on Apple as well. Some of big tech making a comeback. So here's the story for me, Tom. Switch up the board again and get to the bond market. 2s, 10s, and 30s. We rallied for the cyclical parts of the equity market and sold off in the bond market on the anticipation of better economic data. As we start to realize that economic data, we start to stall just a little bit. I don't want to get too cute about this. I'm not going to extrapolate out the last couple of weeks for the rest of the year, but it's interesting regardless just to see what's happening right now. Your 10-year yield up by about 5 basis points, but still slap bang on the button of the average of the last 30 days or so on a 10-year at about 166.56. On a 30-year, we're up 3 or 4 basis points there to 234. But it's interesting, isn't it, Tom? We have to ask ourselves, what is going to be the source of upside surprise? Where's it going to come from regionally in the world, given where the bar is at in the United States and where the bar is at in Europe right now? And I think the FX market more recently, we can discuss this a little bit later, is picking up on the scent of that. Things in Europe are starting to get just a little bit better. The vaccination effort in the last couple of days just getting a little bit better, and things are starting to turn in the FX market too.
And the euro, 118.90, a 119 print on the euro would be a strong week for the euro. The hallmark of what we do here is conversation on market economics and, of course, the perspective of academics. We have lost a great voice in academic economics this week. In Robert Mundell, we spoke to Catherine Mann of Citigroup, and, of course, with her work at the Massachusetts Institute of Technology. We will speak with Richard Clarida later today, former chair of economics at Mundell's Columbia University. But now, Kenneth Rogoff of Harvard University on the dollar and the place within our global system. Professor Rogoff, I mentioned to Catherine Mann this line that goes from modern economics of you and Obstfeld back through Jacob Frankl to the founding of Robert Mundell. In all of that is the politician Valéry Giscard d'Estaing of France, who talked about the U.S. dollar exorbitant privilege. Mundell talked about this for years and years. Are we finally here where we could lose our exorbitant privilege?
Well, first, let me say it's a great tragedy that we've lost Robert Mundell. I regard him as my intellectual grandfather. He was my thesis advisor, Rudy Dornbusch's thesis advisor, and certainly an incredibly original scholar. No, I don't think we're about to lose our exorbitant privilege tomorrow, but there's no question that part of what's strengthened it over the last 10, 20 years is that China's had a very dollar-centric policy. They stabilized against the dollar. Now it's a mix of the dollar and the euro, but the dollar and the euro aren't moving that much. And as long as that holds up, I think the U.S. exorbitant privilege is solid, but it might not hold up forever. It's really not an optimal policy for China. And I might add that if you look at the longer end of 5-year, 10-year debt, and look at, say, the covered comparisons, the U.S. no longer gets any exorbitant privilege. It's really only on short debt.
Ken Rogoff, the basic theme of the less sophisticated is that China not is at war with us, but certainly has a different political system and has a new robust offense. Can they use renminbi as a weapon? Can you weaponize a currency?
Look, they view themselves as doing very well, and they're not looking to rock the boat. Their technocrats have been telling them for 2 decades almost now, you really should have an inflation targeting regime like everybody else. Let us be a little bit more independent central bank. We can keep things stable. We shouldn't be following around the dollar for lots of reasons. The politicians have said, you know, things are going great. Let's not do that. They are looking at the longer run, and they thoroughly intend for the renminbi first to be co-equal with the dollar, at least with the euro, and maybe eventually take over. If we look at a long enough horizon, China continues to rise, that'll be hard to stop. But I don't think they're looking to do anything quickly. That said, they put out this new, starting to put out a new digital central bank currency, which certainly has the seeds of being able to replace the dollar.
Ken, as you see things right now, what do you think is the biggest threat to dollar hegemony? Is it a decision that America could make, or a decision that could be made elsewhere?
I think it would come from, you know, a shock to the system. The dollar hegemony is not something that's going to go away overnight. Typically, when you get on top, you keep it for a century or more. We've had it for a century, certainly since the end of World War I. But on the other hand, if you're, let's say, piling up 60% of the global public and corporate debt in the world, as the U.S. is sort of doing, it just dominates debt issuance markets, and you're counting on that, and that can't go away quickly. It's a fragility, and the late Emmanuel Farhi, together with Matteo Maggiore at Stanford, Farhi was my colleague, wrote this wonderful paper about, you know, the hegemon is tempted to push things, to take advantage of this exorbitant privilege and create fragility that might be a reasonable calculus for the United States, but not for the world as a whole.
So when we talk about that fragility right now, Ken, where's the biggest source of it, do you think? Do you think it is in the debt market?
Boy, well, certainly if interest rates went up, it would turn the world upside down. I think we'll find out a lot when Europe gets out of this, when the vaccines come. That's really the biggest difference between the U.S. and Europe. The vaccines come. As long as Europe, which is roughly as big as the United States, is sort of stuck in the mud, it's very hard to tell what's going on with global interest rates, what's going on with inflation. So I think the U.S. has a while to run before that happens. But when it does, I don't know what's next. Obviously, this has been a very hard pandemic to call, particularly because the waves of it and the vaccines have been vastly more successful than I think almost anyone expected.
Ken Rogoff, this time is different. A book from another time and place, and I'll have the clearest recollection. I think I was at your book party, and I remember opening, and there was that single page you put together with Carmen on the finances of the Spanish Armada. And it was, you know, the Spanish government falling apart. Is our debt structure now Spanish government equivalent when they launched the Armada? I mean, are we in that bad a condition?
Well, listen, if the Armada hadn't crashed because of the weather, we'd be living in a different world history. No, I think it'd take a shock to the system, just a massive shock of which I can't even imagine. But, you know, we've had shocks to the system which we can't even imagine roughly twice in the last 12 years. So we're more vulnerable than we were. On the other hand, by the way, I just want to be clear. I mean, I think it makes perfect sense what President Biden's doing. Certainly politically, it makes sense what he's doing. And, you know, we're in this terrible situation, and he's sort of getting done what he thinks he can get done. And there are parts of the infrastructure bill that make a lot of sense. There are a lot of things we could do in this country addressing inequality.
Right.
I will say, at the end of the day, you have to raise taxes to pay for this. If we're just not necessarily the physical infrastructure, but what they're calling the social infrastructures, transfer programs, great, but you got to pay for it.
Ken Rogoff, James Dimon wrote a 66-page letter this week, he running JP Morgan, and part of the discussion is we have 2 quarters of boom, and then there's a question about how we come out of a boom, the run rate. Do we drop off sharply? Do we ease out of it, if you will? Mr. Dimon, very optimistic about an extended good GDP in America. What is the academic history of how we come off a boom economy, or are we flying blind?
Well, look, we are to some extent flying blind here. This pandemic is quite different than the financial crisis. People who, say there's almost exactly the same thing, that's just crazy. We don't know what's next. If I go back to, I mentioned Robert Mundell, my intellectual grandfather, his student, Rudy Dornbush, had a great book 20 years ago with Sebastian Edwards at UCLA. And a theme of it is that populism actually works great for a while. And their timeline was sort of 2 to 4 years. You get a boom, but then you get problems at the end of the boom. The problem, we talk about, will there be inflation? Will something go wrong? Larry Summers, you mentioned, raised the point. I don't think it's an immediate problem, but obviously if at some point you run the war economy and don't stop, it will be a problem. And politically, it may not be that easy to stop after a couple of years.
Ken, just a final question for me, if I can. On the transitory argument around inflation, we'll catch up with the Federal Reserve Vice Chair a little bit later. How will we know if they're wrong? When will we know? When's the real test for you?
I don't think we'll know for a while. I don't think it's just going to blow up. It's possible, that some commodity price changes will spike inflation for a while, but the core inflation expectations are very sluggish. They're very slow to move. On the other hand, if you keep running a war economy, you just undermine all the things underlying those expectations, and people say it's never going to stop. It will change. That was a theme of Dornbush's book, that populism, if you just keep doing it for too long, blows up. And that's a political question. If you get a lot of stimulus and people say, hey, that worked great, let's do it again. Hey, that worked great, let's keep doing it. That's how you get into trouble.
Hey, Ken, it's good to catch up. It's good to see you.
John, I think I got the book already up and out on Twitter. John, 412 pages, Dornbush Edwards. John, I think that's light reading for you this weekend.
Yeah, thanks for that, Tom. What are you giving us reading for the weekend?
Yeah,
Emily
absolutely.
Wilkins, me, Kenneth Rogoff there, Harvard University professor of economics and public policy.
Ken, thank you.
Tom, the takeaway there, just the amount of humility we still need in this moment, even from someone like Ken Rogoff looking out.
Yeah,
don't know. Just don't know.
Yeah, well, you heard him say that. We don't know. And frankly, Mr. Dimon, I think, made very clear he agrees with the academic that we just don't know. And you wonder, how we reframe it. John, I'm going to say this now for late April and into May. We're going to reframe it through earnings reports and what corporate officers say about the rest of the year.
Earnings begins next week. Earnings season with JP Morgan kicking off. CPI data around the corner as well. And we need to talk about the great vaccination effort taking place in the United States of America. We'll do that next with John Hopkins, Bloomberg School of Public Health. Right now, your S&P 500 all-time highs, up 0.1% on the S&P. We advance, yields advance too. Your 10-year, 167. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Michigan is grappling with a coronavirus surge that has made it the worst place for COVID in the U.S. The state reported more than 8,000 infections and 30 deaths on Wednesday. It's now on pace to surpass its December record. Meanwhile, on a per capita basis, Michigan has the most coronavirus hospital patients in the nation. The UK will decide by early next month whether Britons can resume taking international holidays on May 17th. Countries will be rated according to their coronavirus risk with a traffic light system. It's too early to say which countries would get the green light. In Vienna, Iran's chief negotiator at the nuclear talks says the sides are now focusing on removing U.S. sanctions in a single step. The U.S. hasn't commented on that claim, and there's no word what Tehran is offering in return. So far, the U.S. has ruled out unilaterally lifting sanctions in order to get Iran to return to the 2015 agreement on nuclear enrichment. France's Finance Minister Bruno Le Maire says that what's on the table is a real tax revolution. Le Maire was talking about the increasing prospects for a global minimum tax for businesses. This week, Treasury Secretary Janet Yellen outlined a surprise U.S. drive to overhaul international corporate taxation that could break an impasse amongst 135 countries that have been trying to come up with a deal for years. And in China, producer prices climbed the most since July of 2018. That's a worrying sign for policymakers seeking stable inflation. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Is not fully behind us yet. And while I'm very optimistic and very bullish, I actually have a note of caution. As goes COVID, so goes the economy. And while we're getting closer and closer to having this fully behind us, we do have the last mile to earn and to get to. And so I haven't lost sight of that.
I think they call that cautious optimism from Mary Daly, the San Francisco Fed president, speaking of Bloomberg in the last 24 hours. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz back with us on Monday. Monday. Let's get straight to the session of this morning. Your S&P 500 had a little look at 4,100. Right now, 40.93 and up a tenth of 1%, all-time highs. And the bond market yields higher, curve steeper, up 5 basis points on 10s, 167 as we look to close out the week. Crude a little softer, still south of 60 at 59.56. And Tom, just a brief look at the euro. Euro dollar 118.91. Yeah. Weaker on the session, but the last couple of days, some enthusiasm back in for the single currency.
I note the VIX too, John, 16.95 sustains at the 17 level, which is a real story over the last 14 days. On the pandemic, Andrew Pekos joins from Johns Hopkins University. And there was a period 1 wave ago, 2 waves ago, where we would all play this, as an amateur, we would play this idea of comparing death trend cases trend. We now have a point where cases are flat or even elevating up a little bit, even as we see continued good news on deaths in America. Is there a concern that we'll link like we did 8 months ago, where deaths will come up and rise again with cases, or have we finally separated the two?
Well, the fact that we've immunized, particularly here in the U.S., such a large percentage of our vulnerable populations, the elderly, healthcare workers who are exposed to the virus much more frequently, that should have a major effect on our fatality rate or hospitalization rate, less so on the case rate because we still haven't immunized enough of the general population. So there should be a disconnect between the case rate and the fatality rate. However, the emergence of these new variants seems to be shifting the demographics of not only cases, but also of the severe cases to a much younger age group. Yeah. So that makes it a little bit questionable in terms of how much of an effect we'll see on the fatality rate.
And we will now stop the show and recapitulate a thought of the week, because this is really, really important. Dr. Pekos, when you see 38,000 people at a Texas Rangers baseball game, and they are the Ute of America, I want you to explain the risk of this virus to people who won't die.
Tom, when you said that, I literally got chills down my spine.
John Farrow says that all the time, by the way. Farrow repeatedly says that.
But these are exactly the situations that we cannot put ourselves into at this stage in the pandemic. The case numbers are extremely high. And not to get too technical, but when case numbers are high, surges turn into exponential growth as opposed to linear growth when what we see when case numbers are low. So we don't have enough time to respond to a surge when we start at a very high level of cases, because it quickly gets to a stage where the case numbers are unmanageable. So we have a few weeks now, or maybe even 2 months at most, where we need to keep our public health interventions in place while we're vaccinating the general population. We're doing such a fantastic job of vaccinating people in this country, but we need the other tools to keep the case numbers down. Otherwise, we're going to find ourselves in a situation where we have variants springing up everywhere, and we're going to lose the advantage that we have with the vaccine.
We're doing a brilliant job. We saw 4 million vaccinations last Saturday. The average over the last 7 days, 3.04 million. That's your average daily amount of vaccinations in America right now. Andy, can you help me out with something that I think a lot of people are struggling with? The difference right now between Texas, which reopened 100%, dropped its mask mandate, and cases haven't exploded, and Michigan, where the numbers are really getting worse and not better. What explains that right now?
Well, one of the things right now is timing. Oftentimes, it's unclear when the virus is going to start to take hold and expand out. There are a lot of factors that could make a difference there too. We certainly now know, after a year of seeing the pandemic, that weather does make a difference. Warmer temperatures do reduce virus spread a little bit. Colder temperatures and bringing people indoors may also increase virus spread. So there are those factors that also play into how a surge is occurring.
Do you think we are close to policymakers treating this like the seasonal flu, given how many people have been infected, given how many people have now been vaccinated?
I really do think that, given the efficacy of the vaccine, that we can get this pandemic under control within the next couple of months, provided we can roll out the vaccine, provided that people are accepting of the vaccine, and that will turn the corner for us. While it's difficult to predict anything with this pandemic, the signs right now are that the vaccines are working. The vaccines, in the worst case scenario, may easily be updated to keep up with the virus. And so I think we're in a situation where we can get this under control and really limit the severe disease that is caused by SARS-CoV-2 and deal with case numbers in a way that's similar to seasonal influenza.
But the virulence is still there, correct?
Exactly. The virulence is only going to be modulated by the vaccine and vaccination, which is why it really is going to take a great effort to make sure that everybody understands that and takes the vaccine so that we can achieve that level of immunity in the populations that's going to tamp down the severe cases and total number of cases and give us that control over the disease severity of this virus.
Andy, 12 months ago, did you ever think we'd have a vaccine in the way we have and have a rollout like the one we've got right now?
Absolutely not. I had no idea that the vaccine process would go so well. I had no idea that that the efficacy of the vaccines would be so great, and the speed in which, particularly the Moderna and the Pfizer vaccines, which had never been produced at levels anywhere close to what they're being produced right now, were able to get their manufacturing up and going, is just mind-boggling. So. Again, cautious optimism is the phrase of the day. Perhaps it's been the phrase I've been using for the last month. We have a window opportunity now where if we really buckle down and get control of this virus, we can see ourselves in early summer in a very different situation.
Heard that from Mary Daly of the Fed a little bit earlier on Bloomberg. Doctor, great to catch up. Dr. Andy Peskos there, Johns Hopkins University Bloomberg School of Public Health professor and virologist. Can we get the Bloomberg tracker up for the vaccine again on a Bloomberg terminal? Just take a look at this, and let's make this really simple.
Demanding today.
Europe's starting to shine a little bit brighter, green. That's important. I caught with Maria Tadeo over in Brussels early this morning, Tom. Germany, we've seen 656,000 vaccinations, 720,000 vaccinations daily on a population of about 80 million. That's important. There is still too much white on that map. And Tom, that's going to be the next great challenge, potentially the back half of this year.
I would let the calendar move. I've said this all along. It's a battle every day, every week, John. It can be local, it can be national, it can be worldwide, but it's April. April's not February, and hopefully April's not July. Imagine with this trend line where we'll be in July.
Hopefully a whole lot better. Coming up on the program,
I was talking about the Red Sox. I wasn't talking about
senior
imagine where the Red Sox will be in
manager
July.
of Applied Equity Investors. I'm just going to keep on going. Do you want to talk baseball?
571 ball. They just swept the Tampa Bays.
So you've not given up on the season yet?
No, I'm Calvinist.
It's
I gave
April
up 2
9th.
weeks ago, but
I'm surprised. A little bit of optimism around the Red Sox. Okay.
Yes.
From New York City, alongside Tom Keene, I'm Jonathan Ferro on Bloomberg.
That Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric.
Last year, Norway became the first country in the world to sell more electric cars than any other.
In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
You are going to see rates move higher. The economy is about to accelerate.
Whether there's an uptick in inflation, cyclical, structural, to be determined, but the debate has changed, and that matters.
There are several forces at work here that are slowing down the recovery of the world economy.
As the market rallied, you started to see volatility climb again. That's typically not a great sign.
There's kind of still this catch-up that's happening in correcting for the COVID shock.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
All-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Lisa Abramowitz back with us on Monday. In your equity market, the S&P 500 futures up about 0.1%. Record highs. Tom, this has been a 25% rally since the end of October on the hope that things get better.
Oh, come on.
And now we're starting to see the data.
We're there
There's
right
no
now. Hope. We're no hope right now. When we speak with Richard Clare today, it's not going to be about hope. It's going to be about the reality of a boom economy. John, the levels 4,100 we're going to touch here in a cup of coffee. And the coffee's good this morning.
You've got to let me complete the sentence, Tom. I was with you. We're on the same page. Carry on.
There's another break exclusive. We're on the same page. How rare is that? But, John, I'm looking at levels of equities, and they tell me boom economy.
We're looking at NASDAQ snapping back. That rotation, Tom's flipped the other way, and I think that's interesting too. We need to discuss that. We've had a big rally off the March 8th low on the NASDAQ 100. On Apple, just to pick a name, 11, 12 percentage points. Is that just a pause from what we've seen in the last 6 months, or are we going back, snapping back the other way, Tom?
I'm going to wait till earnings and those expectations out. I mean, how brave are corporate officers going to be to get out to a Q3, Q4 guesstimate? I think we're going to hear a lot of them say, we really don't know. And then it'll be within the conversation of the conference calls where you get an idea of margin sustainability, but critically, what does the revenue line do in a boom economy?
JP Morgan kicking things off next week with earnings, Tom. We get inflation prints on Tuesday in the United States of America. Then the debate really picks up. This is what the price action looks like right now. Cross-asset worldwide, beginning in the United States with the equity market with a little bit of a lift on the S&P 500 futures. Had a sneak peek of 4,100. What a turnaround. Do you remember when 4,100 just felt like ridiculous?
David Costin was out of his mind. I remember when Costin was on the show. He graces his presence once a year. I think we talked to him, and he was nuts.
And now he's looking for what, Tom? 4,300 year-end, I think, over at Goldman.
And there's others. There's others as well.
He's not alone. In the bond market, yields are higher by about 5 basis points on 10s to 166.74. So that's the story of the market. Tom, we have to pause as well because we're getting some sad news out of the United Kingdom that Prince Philip, the Duke of Edinburgh, has died. That headline just crossing the Bloomberg right now, Tom. So if you're just tuning in worldwide on TV and radio here at Bloomberg, we are getting that sad news out of the United Kingdom. Prince Philip, the Duke of Edinburgh, Tom, has died.
Hey, John, this is just such a moment, and I'm just honored, frankly, to be here with you to speak about this. And we're going to get to Andrew Slyman here in a moment, but we need to speak here of the two of them so ancient as well. John, how would you suggest the United Kingdom will greet this news so widely anticipated?
With great sadness, because he has been a permanent fixture for so many generations, Tom. This gentleman would have turned 100. He was age 99. He would have turned 100, I believe, in June, on June 10th. He's been at the side of the Queen going back to the days of her being a teenager when they first met, Tom.
Yes.
And they carried on corresponding with each other when Prince Philip went off to war, and then, of course, came back. And I think at the end of the 40s, 1947, the two of them got married. And he has just been a permanent feature of the royal family for so many of us that have grown up in the UK and in the Commonwealth too.
Not to put you on the spot here, John, but I do think it's an important question for our global audience. We have seen two esteemed actors attempt Prince Philip within the acclaimed show The Crown. From where you sit and all of your contacts in Britain, did they even come a fair bit close to capturing this gentleman of the Greek royalty?
So unfortunately, Tom, I can't say that I've watched The Crown as much as you. I think it would be hard to match the personality of Prince Philip, which has just been so different for so many people. This is a man with character, a man that had character in a way that I think many in the royal family, Tom, did not. And I think a lot of people in the UK, particularly in British society, would like to see a lot more character from the royal family at times of stress like this one. So let's see what comes out of all of this. It's an important time for the royal family, as we know, Tom, for all the wrong reasons over the last couple of years. And I think this is a time to come together again and think about the work that this particular man has done for this country, the United Kingdom, and of course, the Commonwealth and all around the world.
Well, there we are with news that has been widely expected in the hospital here a number of weeks ago. And of course, Queen Elizabeth a few years behind and very vital at this moment. John, why don't we try to migrate the program forward? We'll have much more on the death of Prince Philip here through the morning.
Yeah, let's pick it up on the markets and we'll turn back to that news as we progress through the show, Tom. We've got a great lineup for you on financial markets with the Vice Chairman of the Federal Reserve, Richard Clarida, joining us in around about 55 minutes' time. As we anticipate that interview, we need to talk about this bond market. Things have stabilized in treasuries over the last month, at least. On the session, things are a little bit different. Yields are higher by about 5 basis points to 166.56. What's happened in the equity market, though, is really important. The NASDAQ has snapped back. Can you extrapolate that out a couple more months? I don't know. Let's talk to Andrew Slimmers, shall we? Morgan Stanley Investment Management Senior Portfolio Manager of Applied Equity Investors. Andrew, let's start right there. The NASDAQ snapback, your read across, please.
I think it was oversold. It had a pretty big correction, especially some of these, very speculative tech stocks had pretty substantial, some of them down 30%. So a little relief on the 10-year, and that gave the kind of the elixir for these stocks to snap back. But, at the end of the day, I think rates are going up, and I think this is still, a dangerous area for investing, given the valuations that still exist. Not the mega cap tech stocks, but some of the, even faster growing, more speculative tech stocks.
Andrew, we talked so much about anticipating this better data. Hope, Tom and I started the hour with it. We're starting to see it now. As Tom pointed out, it's not just hope, it's real. You saw it in payrolls last Friday. We see it in retail sales. We'll see more of it. Is there something different about how you anticipate the data and how you position a portfolio for that, and how you position once you start to realize it?
Absolutely. Never forget. I mean, this. Stocks are forward predictors. So now the data is validating what the stock market's been telling you for, the last 9 months. And so I think many of these reopening stocks, they're sales. You should be we're beginning to trim back many of the reopening stocks because the economy is reopening and the stock market is going to pivot to the next story. It's not the reopening story. Maybe in Europe, Europe is still a little bit behind us, but I think the real issue is what's the next thing around the corner. And with the VIX down to the mid-teens, I'm a little bit more cautious here than I've been.
Okay, Andrew, I'm hearing the caution as well, but then what is it to do? What is your experience of the phrase go to cash? Because if you go to cash, there's a point where you got to get back in. Are we like a 4%, 5% tasteful cash in case one of the kids needs something? Or are you like 40 or 60% in cash?
Yeah, so that's a great question. So first of all, look, I run equity mutual funds. I have to stay relatively invested, but we adjust the beta in our portfolios. And what has so worked here until recently is high beta especially high beta, reopening value stocks. So I think at this juncture, what we're starting to see, Tom, is that value stocks are continuing to work, but not high risk value stocks. It's the safer value stocks, some of the higher quality financials, industrials, even some of the energy. I think you want to adjust the risk down. Now, in terms of going to cash, look, I think it'll be a good month because I do think the quarterly earnings will be good. But I think having cash on hand so you can capture if we do have a 10, 15% correction, which I think is coming at some point this summer, you want to be a buyer into that. So you got to have some cash available, to capture that.
I mean, John, I think this is so important. The definition of a correction, 10 or 15%, a bear market, 18%, and the oops of a negative 35%. We tried to go down to correction here a number of months ago, didn't get there.
Saw it a little bit on the Russell, I think, Andrew, just to jump in. I find it really interesting, Andrew, that we're talking to people like you. I've had the same conversation with BlackRock that maybe have a cash allocation. Volatility is going to pick up through the summer as we start to have this tug of war, this big debate over inflation as the data comes in. Yet volatility just keeps declining. We keep chipping away at the VIX, Andrew. Why do you think that is?
Because the economy is reopening, John. Because the VIX has remained elevated versus pre-pandemic. Pre-pandemic, it was in the mid-teens. It's remained above 20 for a year. It only finally has broken back to pre-pandemic levels. And I think that's consistent with consumer confidence is now coming on. The economy is reopening and things are getting back to normal. You want to be invested and being optimistic when people are cautious, right? I'm sure people have been coming on this show for a year now, John, saying, well, I expect more volatility in the future. Well, that's because they're looking in the rearview mirror, right? Now you don't hear people talk about more volatility because there hasn't been a lot of volatility lately. You want to be more cautious when the coast is clear, when the green lights is flying, it's all safe to invest. And that's what the VIX is telling you now. And that means the market can't withstand bad news. When the VIX is elevated, people are expecting bad news. So bad news like a re-outbreak last fall didn't cause a big correction. That's the key here. I want to go back to this cash level if you have a moment, because I think it's a really important concept, which is, yes, we had a big correction last year, obviously, but 20% more corrections are very rare. So if you have cash on hand and you invest, say, down 5%, you add more down 10, you add more down 15, the odds are you're going to be well rewarded over time by investing into weakness in the market. So I'm a big believer in a very, kind of algorithmic way of unemotional. When you get pullbacks, you automatically put more money into the market because the odds are they're going to stop, down at that level. And I think that's what's going to happen this summer.
Andrew, it's good to catch up with you, sir, as always. Trying to take out the emotion at the moment. Andrew Slimman, Morgan Stanley Investment Management Senior Portfolio Manager. We'll drain the drama out of this situation a little bit later with Richard Clarida, the Federal Reserve Vice Chairman. But we need to talk about the emotion of this moment elsewhere. As we hear from the royal family in the United Kingdom on Twitter, from the palace, they say the following: "It is with deep sorrow that Her Majesty the Queen has announced the death of her beloved husband, His Royal Highness the Prince of Philip, Duke of Edinburgh. His Royal Highness passed away peacefully this morning at Windsor Castle. The coverage will continue. Aged 99, Prince Philip has died."
With the First Word News, I'm Ritika Gupta. Most coronavirus vaccines are going to the wealthiest countries. So far, 40% of the COVID vaccines administered globally have gone to people in 27 wealthy nations that represent 11% of the population. That's according to the Bloomberg Vaccine Tracker. Countries making up the least wealthy 11% have gotten just 1.6% of the vaccines. In other words, countries with higher incomes are vaccinating 25 times faster than those with the lowest. Fed Chair Jerome Powell is pledging to get the U.S. back to a great economy. Speaking to a virtual panel, Powell said that he drives by a tent city for the homeless on his commute, and that reminds him that millions of Americans are still trying to find jobs. Powell also downplayed the prospects of inflation. Dozens of U.S. and European banks may throw their weight behind the White House's Earth Day summit. That's a part of plans being drawn up by former Bank of England Governor Mark Carney. Carney is expected to unveil the Glasgow Finance Alliance for Net Zero during the summit April 22nd and 23rd. The banks will pledge net zero emissions by the year 2050. And another problem for the Boeing 737 MAX, the company's identified a potential electrical issue on some of the planes. It's alerted 16 customers they should ground the jets until the problem is resolved. The issue is not related to the nearly 2-year grounding of the 737 MAX after those 2 fatal crashes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro and Tom Keene. Lisa Bramwitz off today. Thank you so much for being with us. An important conversation in 50 minutes. Richard Clarida will be with us, the Vice Chairman of the Federal Reserve System. Prince Philip is dead at 99. This has been widely anticipated. Our Kevin Cirilli joins us now from Washington. Kevin, I want you to reaffirm President Biden's approach with the United Kingdom as he reaches out to our allies. Prince Philip was someone who walked one step behind the Queen, even as President Trump tried to walk one step before her on one of his visits to London. What will be this relationship of the Biden administration, a new relationship with the United Kingdom?
Well, look, it's a special relationship, first and foremost. But secondly, this is an opportunity for President Biden, as well as his administration and the U.S. Congress collectively, to really underscore just how special that relationship is for a host of different reasons. And I would anticipate that some top high-profile members of the administration, potentially even the president himself and the First Lady, would be attending some of the services, although I don't want to get ahead of ourselves because we don't have any confirmation of that. Secondly, this comes at a crucial point, as you alluded to, not just for the U.S.-UK relationship, but the EU, UK, and U.S. dynamic as a whole, particularly from a geopolitical and a national security perspective at a time in which trade deals are on the table, as well as there is a reorganization on how to confront authoritarianism regimes, including the rise of the Communist Party of China.
Kevin, are we seeing a reaffirmation of the Washington consensus? I mean, in the 100th anniversary of the Council on Foreign Relations, is President Biden going back to Dulles and old school?
Yes. I also think that yesterday that report issued by the National Intelligence Council, the Global Trends by 2040 report, tacking in at about 150 pages, really outlined the national security and geopolitical concerns of the future that are really underway already, especially from the vantage point of countering China, for example, from a technological space, from a future technology space, and also from an outer space perspective about really the dynamics of what's at stake as technology continues to outpace itself.
Kevin, I've got to say I found the messaging from this administration on infrastructure, relatively speaking, much more complex and muddled than the messaging around the relief plan that they delivered a couple of months back. In your mind, do they need to address that? Are you having conversations like that in D.C.?
Yes, they have to. They have to be able to juxtapose that a green job means a working class job, that a green job means a middle class job, and to transform industries that candidly are trending in a direction into a new shift in global economics. And they have to be able to communicate that. I think Commerce Secretary Gina Raimondo is really at the forefront of that, given her gubernatorial experience. But April 22nd and the Alliance of Democracies at the Biden administration is going to be rallying. It's going to be crucial that places like Youngstown, Ohio, for example, believe that their auto plants are still going to be up and running in 2040, but maybe they're going to be making solar panels instead of car parts.
Kevin, is the real outreach to the Republican Party on this front? And when I say real, I ask that question because I don't think we can really characterize the last effort as real outreach.
Candidly, Jonathan, I think that the real outreach remains to try to get Democrats on board, and that's going to prove to be a significant challenge for them. Senator Joe Manchin and Chris Coons are worlds apart from the left flank of their party. When they're saying that they are against raising the corporate tax rate, that is a chief opportunity for how Secretary Yellen as well as President Biden have suggested that they be able to pay for their $2.25 trillion infrastructure package.
Is that a marginal debate? Is it yes or no? Or do you just assume there's a number in the middle, Kevin, where they'll sort it out?
There's a number in the middle. I do think it is part of a larger marginal debate. Yesterday, the administration proposing a $714 billion defense military budget. That's lower than the previous administration, the Republican administration, but it comes at a time when the U.S. has already spent $4.1 trillion on stimulus, and the Biden administration is proposing $2.25 trillion for infrastructure. So, you know, it's a lot of money either way you look at it.
Kevin, good to catch up. Kevin Cirilli down in Washington, D.C. Kevin, thank you, sir. Catch Kevin on Sound On Bloomberg Radio weekdays at 5 p.m. Eastern. Kevin on the politics and the policy of the moment. Sometimes you have to park the politics, the policy, the economics, the market talk of the moment and focus on what's happening right now worldwide. And that is the news out of the United Kingdom right now from the royal family and on Twitter just moments ago. It is with deep sorrow that Her Majesty the Queen has announced the death of her beloved husband, His Royal Highness the Prince Philip, Duke of Edinburgh. His Royal Highness passed away peacefully this morning at Windsor Castle. Prince Philip has died, aged 99. Let's head out to London and catch up with a good friend of ours, Guy Johnson, Bloomberg Markets anchor, joining us from Queen Victoria Street. Guy, the response in London right now.
I think to a certain extent, this was something that was anticipated. He was 99. He'd been married to the Queen for 7 decades. There will be no state funeral, though, John. That was his wish. So there will not be the formal national holiday. There will not be the formal state funeral. That was down to him. That was his decision that he made. He has been at the center of the British establishment ever since he married the Queen as she was to become in 1952. Back in 1947, he was a successful naval officer. He has been at her side ever since, and as a result of which, this is a day of deep sorrow for this country. The royal family, despite its recent problems, remains at the center of the British establishment, at the center of the nation, and also the Commonwealth. So a day of deep sadness, I think, for so many people, Tom.
Guy Johnson, Queen Elizabeth will be 95 on April 21st. I believe that's in 13 days, if my British math is correct. It is a generational change, a long time in coming. How does Prince Charles wake up this morning? How does life change for the Prince of Wales?
I think Prince Charles wakes up this morning with a heavy heart, Tom. His father has just died. I think he is probably looking backwards, not forwards. I think he's probably remembering his life with his father. It was a relationship that obviously defined both of them. But what happens next to the Queen, I think, is probably a story for another day. As you say, she is a few steps behind in age of Prince Philip, but nevertheless, I think this is something that the nation is not really ready to accept at this point. She has stabilized the royal family in a way over many generations that I think has had a huge impact, not only on the family, but also of the nation. She is the longest serving monarch this country has ever had, Tom.
When did he become British? I mean, you know, we all watch The Crown, and, you know, I'm a rank amateur at this, Guy Johnson. I think what you and John Farrow are doing here is absolutely phenomenal, the authenticity of what you've lived your entire life. When did he become British from, as he said, he was from the Balkans, as simple as that?
Yeah, he was born to the Danish and the Greek royal families. He was born in Greece. It wasn't an easy transition, but he became the husband of the then-to-be Queen. It was a period of huge turbulence, Tom, because of the abdication, and we'd been through that. Her father obviously became king, and then she, in 1952, 1953, when the coronation was, became queen. It was a period of turbulence, and she provided huge amounts of stability around that. He became part of that establishment. He became part of that firm, as it is known here in the United Kingdom, and provided the Queen with somebody to be a confidant. And I think that was a huge part of his role in this whole process. And he's been with her ever since. And you look at the stabilizing force that she has provided. He has been part and parcel of that mixture, Tom. He was, as you can see in all of these pictures, right there with her at all of those critical events. And I think the country and the Commonwealth and the world, I think, will look back with great fondness at what he achieved. It wasn't without sort of difficulties along the way, but I think most marriages probably experience that, and I think certainly he provided the stability that she was looking for, Tom.
If you're just joining us on Bloomberg Radio and Bloomberg Television, the death of Prince Philip at 99 years old. John Farrell?
Tom retired from royal duties back in 2017, aged 99. Guy in many ways anticipated, but I don't think that diminishes or removes the sadness from the moment. It's an important moment overall, more broadly, for the royal family, which has found itself in the news for all the wrong reasons, particularly over the last 12 months, Guy. We need to talk about that now. This is a man who's been a permanent feature of this family for much of the last 60, 70 years. Now we need to talk about the future and the royal family's position, not only in the United Kingdom, but also in the Commonwealth too. What does that look like in the next decade, Guy? What does that look like in the next 20 years? And you and I don't have the answer to that, but that's the conversation right now.
Yep. I think there is a discussion that has been increasing over the last 12 months, John, as a result of what has gone on within the royal family, about a slimmed down royal family, which is something that you see in many other nations that have royal families, that you slim the royal family down to the core of what that family is, and as a result of which provide more focus and more clarity on what their role is. Because I think as you have this extended family occupying a undefined role, I think things get more difficult. And I think there is certainly an active discussion about what will happen next, who will make that decision, and exactly how tight a group we're talking about. But I think that discussion is certainly something that I think is going to be with us for quite some time.
Guy, thank you. It's good to catch up, sir. Guy Johnson over in London. No doubt he'll continue our coverage a little bit later this morning. And no doubt we'll hear from heads of states around the world with response to the death of Prince Philip. Just 30 minutes ago, we heard from the royal family out on Twitter that it is with deep sorrow that Her Majesty the Queen has announced the death of her beloved husband, His Royal Highness the Prince Philip, Duke of Edinburgh. His Royal Highness passed away peacefully this morning at Windsor Castle. Aged 99, Prince Philip has died.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live on TV and radio for our audience worldwide. This is Bloomberg Surveillance, and here's the price action of the moment. The S&P 500 futures, a sneak peek, had a little look at 4,100 on the S&P 500. Unreal this move since late October. Unreal this move since 12 months ago. Right now, up another 8 points. We advanced 0.2%. NASDAQ outperforming over the last month, just underperforming relatively speaking on the session so far, unchanged. Your Russell at the moment advances about 0.5%. Coming into Friday, it was down on the week by a similar amount, down about 0.5%. The NASDAQ 100 on the week, up by 3%. Big week of gains. Elsewhere, switch up the board into the bond market. 2s, 10s, 30s, we look like this. Your 10-year Treasury yield's a little bit higher, at 4 basis points to 166. In about 30 minutes' time, we'll catch up with the Vice Chair of the Federal Reserve, Richard Clarida, live and exclusive on this show. Looking forward to that conversation. If you think about the moment we're in, where we've come from in the last 6 months, it's about the anticipation of better data, and now we are starting to see it. So what does it mean for the FX market? Switch up the board and finish on this, on euro dollar. It is always about relative data to expectations. Where's the data relative to expectations? Where's the outlook relative to expectations, and how does it change? We need to think about the vaccination effort in America. It's all well known. How well priced is it? Let's talk about the vaccination effort in Europe. We've talked about how bad it is. Last couple of days, record daily vaccinations in Germany. And you know what? I think euro and euro dollar in the FX market more broadly can smell it. Euro dollar started the day with a 119 handle, 118.92, Tom. That's the euro against the dollar. Take a look at euro sterling. You and I talked about that vaccine trade earlier in the year. Just starting to go the other way. A 2 percentage point move in the euro's favor this week against sterling.
John, it's a Thursday, Friday story. I mean, we've seen, the NASDAQ story to me is a story of the week, how NDX has come back. But I do take your point. And the euro to me has just been Thursday and Friday, and all of a sudden, here we are looking for a 119 print. We're not there yet.
Had it earlier this morning. I think we've got to talk about, Tom, surprises. Where the positive surprise is going to come from. Are they going to come from America with the bar right up here for the outlook, or do they come from elsewhere? Do they come from Europe? And Tom, do you think we're already starting to see people start to gravitate towards that story just a little bit more in the FX market over the last couple of days?
On a macro basis, yes, that's true. But I think where they're really going to come from is the old use of cash. We're going to figure out what corporations do. Jim Suva at Citigroup saying this is the time of the year where Apple comes out and moves up the dividend and announces share buybacks, and he thinks they will be bigger than large.
Earnings season kicking off next week with JP Morgan. Looking forward to that. The coverage continues in about 28 minutes. The Vice Chair of the Federal Reserve, Richard Clarida, looking forward to that too. Let's get you some movers. Romain dropping into the studio. Hello, Romain.
Hey, good morning, John. Yeah, another quiet day out there here in the pre-market action. You are seeing some of those big mega cap names, kind of what Tom alluded to there. A lot of investors really gravitating to those names where they know they are going to peel off some cash here over the next few months here. You're seeing Amazon get a slight bid here in the pre-market hours. Of course, the other catalyst here for Amazon is that union vote going on down in Alabama, at least right now, based on Bloomberg reporting. The count seems to be tipping more in Amazon's favor, but they still got about half the votes to go there. We had Michael Pachter on yesterday on Bloomberg Markets at Close saying he doesn't really anticipate a huge financial hit to Amazon should it actually lose on this union vote, saying that most of the additional costs there would be easily absorbed by the company. Keep an eye on Boeing here. Some word out here that they're actually having some electrical issues with 16 customers with regards to that 737 MAX jet. This is an issue completely unrelated to the previous issues with that jet there, but that's weighing a little bit on the shares. And Levi getting a nice little bid here after reporting earnings that came in above estimates. You flip up the board, we're going to keep an eye on the semiconductor space. Taiwan Semi out with earnings. They were pretty decent here. You're seeing actually some activity here in the U.S. names like KLA and some of the other names as well. Carnival Corp getting a nice bid on an upgrade here on the potential resumption of cruising, and Nike settling in that suit with rapper Lil Nas X getting a nice little pop here in the pre-market.
Romain Bostic, thank you so much. Greatly appreciate that this morning. Again, Richard Clarida here in 25 minutes. Right now, Tom Porcelli with us, RBC Capital Markets on the American economy, and of course his wheelhouse looking at the labor economy and our wage dynamics. Let me digress here, Tom Porcelli. What is the question you'd ask the Vice Chairman?
What does substantial further progress mean, right? And look,
and in fairness, maybe it's a question that he can't answer, but I'd rather them just say that, right? Instead of saying like, you know, all this colorful, you know, well, right. You know, we want to see, you know, improvement in the labor backdrop. I want more guideposts. I mean, I think that's the thing, and I wouldn't let him get away with just giving me a response that, you know, didn't really answer the question. I mean, I would push back.
Tom, John Farrow, that's why I'm the nice guy with Clarida, and John is not. So
I think Tom knows what's coming in about
Farrow,
30 minutes.
I'm going to ask some sweetheart question to the good vice chairman, my good friend Richard Clarida. We're going to finish with his comments on Mundell, and then Farrow in between. We'll go right at it. John, why don't you pick it up here with Porcelli?
Jonathan, give him heck. I mean, I wouldn't look. I wouldn't let him get away with just, you know, saying we want further progress on labor without really sort of defining them more. And look, and in fairness, maybe it is a little bit too early. You know, maybe they do want to talk about it in sort of broad strokes, but I think pressing him a bit on that, and maybe that's the answer. Right? Maybe the answer is, hey, fine, if that's what. So you're telling us that you're just not ready to define it yet, right? Like, just give us something. But I'll tell you what, my sense is that, you know, the way that Powell has been talking about this, you know, how many times has he said, you know, there's 10 million people on the sidelines, there's 10 million people, well, now it's after Friday, it's 9 million people. But like, my sense is that that's probably one of the guideposts, right? I mean, one of the sort of the lines in the sand is probably that. I think they want to probably claw some of, if not all of those folks back. But again, I just want some clarity on that. I think that's totally reasonable. But again, I'm sympathetic if they think it's just a little too early to sort of define it.
Well, let's have the conversation right now.
Then, right? I just want them to say that. Just say it's too early to define it.
Tom, I hear you, but I just wonder for them, I think they think it's working. They think it's working right now. And I guess the question for them right now is whether they think it's necessary to even define any of those things. I mean, is it working from your perspective? Just look at the price action.
Yeah, no, like I said, I totally get it. I mean, I don't know that they necessarily need to say that today, because the reality is, Powell and company still have the cover of, hey, look, you know, virus cases are on the rise in some places. There are variants coming out, right? I mean, you still have that as sort of a, you know, a good reason to not sort of worry so much about what's going to happen in the second half of the year. But let's be clear, when things evolve, it's going to evolve fast, right? Like, you're going to see the second half, and actually, sorry, things are already evolving fast now, right? I mean, we're going to have 10% in Q1. But I think in the second half of the year, I think you're going to see things really start to ramp up. So, you know, they're going to find themselves sort of behind the curve. And again, in fairness, they're almost always behind the curve, right? I mean, I don't know if there's been any instance where they are not behind the curve. And again, in fairness, that's probably where we want them, right? I don't want them crafting monetary policy based on their forecast. Yeah. I don't think any of us should. I mean, I think we want them to respond to, you know, sort of what's on the ground, but that doesn't mean that, you know, it's not helpful for us to at least have some framework for thinking about what they're thinking.
Well, everything we're complaining right now, Tom, I just wonder, is it a feature or is it a bug? And I just keep hearing you, and I'm thinking right now, I guess it's a feature and not a bug.
It is. It is a feature. There's no question about that. But again, then once we get into the point where, you know, it's going to be obvious to my 7-year-old that, you know, the economy is ripping. You know, I think it's going to be important then to sort of define it. And look, the Fed has not been great about defining exactly what they're looking for, whether it's many months away from you know, policy action or when we're in the thick of it.
Tom Porcelli, the nexus of this debate is something you are expert at. That's studying the wage dynamics of this country. It's the inflation worry, wage inflation comes in, and it's also a statement on the labor might that the Fed demands that America have. Describe that nexus right now and how you'll study it later this year and into later next year.
Yeah, Tom, I think this is such an important question. I think one of the things that one of the things I think is totally underappreciated is think about how we come out of a recession, right? Almost any recession, it doesn't matter. After just about any recession, what you tend to see is, you know, sort of the wage dynamic has just been decimated, right? Like there's
okay, traders,
no wage pressure.
Bitcoin, are you ready to play stop and profit? All of you guys who hold Bitcoin for a couple of days, it's time to place stop and profit. The price I'm looking to place, let's see, we will place stop and profit 58,187.5 we purchased. Bitcoin, we will add 0.2%, and the price I'm going to place stop and profit 58,304. Okay, so guys, all of you who purchased Bitcoin, just to be safe, and this is how day traders working, you need to place stop on profit at 58,303. We need to go even lower, 303. This way, anything can happen with Bitcoin, especially these days. It's kind of volatile market, and you will not lose anything at all, and you will end up in profit in our case, and in your case, because all of you who follow trades, we purchased at 58,187.5, and we already in profit, will be in profit if it change direction, 0.2%. Okay, guys, well done. Well done. If you want to get the strategy, you know where to get it, from company.co.uk. You can get from our streamer as well. Lots of information over there. You can register for 15 minutes session. That's free. You don't have to pay anything at all. Also, you can register for webinar. If you want to become a full-time trader, please do so. If you want to become part-time trader, try it. You get the strategy. You can trade different pairs, stocks, anything you want, as long as it's tradable assets. Okay? Stay safe. I'll speak to you later, guys.
Story up a couple of times, Tom, and you've talked about it too, so give yourself some credit. We're applying the lessons of the previous cycle. We've been conditioned by the previous cycle. The people in power now, Chairman Powell, Secretary Yellen, have been conditioned by the previous cycle, and they're taking those lessons and applying them to this moment, and this moment is so different to anything we saw in the previous cycle.
Well, I'm so glad you bring this up, John. I'll be real quick about this. The only equivalency is 47. It's a false equivalency. And the Fed was in crisis 3 years later with the courage of William McChesney Martin. The independence that Clarida and Powell have came from the last time we had this kind of boom economy, and then what to do about it.
Building up to an important conversation with the Vice Chair of the Federal Reserve, Richard Clarida, joining us in 20 minutes' time. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. He was known for his gruff public persona and for helping modernize the British monarchy. Prince Philip, the husband of Queen Elizabeth, died today at Windsor Castle. He was 99. Philip was a penniless Greek royal who married Elizabeth in 1947. While he had no official role, he became viewed as one of the most influential members of the royal family. Philip always walked a step behind the Queen at the thousands of public events they attended. On their 50th wedding anniversary, she said Philip had been her strength. Michigan is grappling with a coronavirus surge that has made it the worst place for COVID in the U.S. The state reported more than 8,000 infections and 30 deaths on Wednesday. It's now on pace to surpass its December record. Meanwhile, on a per capita basis, Michigan has the most coronavirus hospital patients in the nation. The UK will decide by early next month whether Britons can resume taking international holidays on May 17th. Countries will be rated according to their coronavirus risk with a traffic light system. It's too early to say which countries will get the green light. Amazon has taken a commanding lead in a historic election. The vote will determine whether workers at an Amazon warehouse in Alabama will become the first in the U.S. to join a retail union. With about half the votes counted, Amazon's ahead by a 2-to-1 margin. The Retail, Wholesale and Department Store Union calls the system broken and says it will appeal. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Populism, if you just keep doing it for too long, blows up. And that's a political question. If you get a lot of stimulus and people say, hey, that worked great, let's do it again. Hey, that worked great, let's keep doing it. That's how you get into trouble.
That's how you get into trouble. The words of Kenneth Rogoff there, the Harvard University professor of economics and public policy, catching up with us right here on Bloomberg Surveillance just moments ago. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz back with us on Monday, getting a long weekend in. Let's have a look at the price action for you to get you set up for this Friday morning. Good morning to you all. Equity futures breaching 4,100 briefly on the S&P 500. Right now, 40.95, up around about 0.1%. Record highs at a close yesterday. Coming into Friday, we look to add a little bit more weight to that. In the bond market, yields up 4 or 5 basis points on 10s to 166.74, and just teeing us up for a really important conversation 12 minutes away, Tom, when we catch up with the Vice Chair of the Federal Reserve and an old friend of this program too, Richard Clarida.
Richard Clarida be with us, and we've got lots to talk about. I was joking yesterday we'd make it a 35-minute conversation. I don't think we'll get there, but we've got a lot to talk about with the Vice Chairman, and what he knows is labor is a huge part of the study of the Federal Reserve System, and part of labor is a study of the atomization of the American labor economy. Joining us right now is the #2 most important person in Detroit, Michigan. Akil Babu of the Detroit Tigers is without question the most important person in Michigan right now, and as well, close behind, Andrew Levin, the Democrat from Michigan. Andrew, I want to talk here, and I think the path here so much goes from your esteemed father, the liberal Democrat that Republicans respected, Sander Levin, and the path of labor economics in Michigan that spans his term in public service, and now you with the 9th District of Detroit. The State of Union, this Amazon union battle, is there any sense that President Biden can get a rekindled union movement?
Absolutely, Tom. What this election in Bessemer, Alabama, of 5,800 workers, young workers, overwhelmingly African-American workers, represents is a revitalization of worker organizing in this country. And it looks like they won't win this election. Not a surprise to me, given the level of oppression Amazon has rained down on them throughout the whole process. But it just shows how broken our system is. I've been listening to your clips about stimulus. The real thing we need to do to transform this economy is simply allow workers the freedom to form unions and bargain collectively again. That's been gone for decades. We're down to 6% of private sector workers having a union in this country. They've got no leverage, and that's why all benefits go to the very wealthiest people.
What is the topic that is under argument? Amazon says they do wages, $15 an hour, whatever it is. I assume there's a benefit package commensurate with the job skill in that. What is the union criticism that you observe as a labor pro?
Well, for one thing, you all keep calling it a retail workforce. This is a warehouse, Tom. Warehouse wages are not McDonald's or, grocery store wages. It's a different sector, and $15 an hour is not such a great big deal in warehouse.
Okay.
Secondly, that's just wrong. Secondly, this isn't about just money. Yes, this company is owned by the richest person in the world who got $68 billion richer during this pandemic for doing nothing, and these workers are scraping by. Money matters, but the key thing is basic dignity, being a human being. Did you see Twitter blow up and all other social media when the company said, nobody pees in bottles, no one would work here, our million workers or whatever they said, and people just reacted with stories, streaming over stories about their pee bottles in their trucks and at their workstations. Working for Amazon, you feel more like a piece of machine or a robot than a human being. And the only way to change that is for workers to get a seat at the table and negotiate a dignified workday.
Congressman, there's something about the modern economy, just to jump in, where people really appreciate Amazon from a consumer perspective, yet we all acknowledge there are issues within the company. Yet this has become part and parcel of the modern day economy. And I wonder, Congressman, whether you think there is a broader issue here. There's something toxic about the way we interact with these companies now, whereby we want everything cheap, we want everything convenient, and a lot of people actually really appreciate the company. And you said that Jeff Bezos didn't do a lot last year. I think a lot of people would argue that Amazon did a lot for everybody's lives through this lockdown last year, and I'm sure you would agree with that, Congressman. But do you think there is something toxic about our relationship with these companies, yet at the same time, the abuse that you allege is happening behind the scenes?
Yeah, but Jonathan, this has been going on forever. First of all, I said he personally didn't do a lot. No one can defend the idea of getting $68 billion richer. What does that even mean?
Yeah.
So to answer that's a sickness right there that we have to address. But to answer your question, this is an old story. We loved Model Ts. My God. We loved Walmart. Walmart was cheap, 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 right?
Yeah.
Walmart is the biggest private sector employer in this country with something like 1.3 million workers. Not one person has the benefit of a collective bargaining contract to give them the idea that they would only be fired for a just cause.
Why don't they have the power to do that? What is precluding the workers of Walmart from unionizing?
The labor laws. Let me just put it this way. If Bessemer, Alabama was a foreign country and Jimmy Carter flew in, God bless his soul, or Human Rights Watch, whatever, to monitor the election, they would have flown out weeks ago. They would have held a press conference and say the oppression these voters are facing, the unevenness of the playing field, the idea that this could be a free and fair election is absurd. We're going back to Georgia because we're proclaiming today that there's no fair election possible. I mean, if you want to go down the list, Tom, I'm really happy to do it. The company is allowed to force workers on pain of termination to attend anti-union propaganda meetings all day long of their shift. And if a union representative steps foot on their property, they arrest them. The election, where was it even held? The workers under our legislation, the PRO Act, or the Protecting the Right to Organize Act, it would be up to the workers to decide. Have an election at their workplace or a more neutral place or an electronic election, like is standard for railway and airline workers. Not under this law. 40% of the time, employers in these elections illegally fire people. The penalties are basically nothing. You know what? If you're fired because of your race or religion or other things, there's all kinds of damages. Here, there's basically none. Our labor laws basically incentivize employers like Amazon and Walmart and small ones to break the law to prevent their workers from forming unions.
Congressman, this is a subject worthy of a much, much longer conversation, and I want to give you the time to do that, so please come back soon because we're up against the clock on this program, so forgive me. Congressman Andy Levin there, the Democrat from Michigan, from New York City this morning, alongside Tom Keene. I'm Jonathan Ferro. We will continue this conversation on the labour market, on the broader economy, and we'll do that with the Federal Reserve Vice Chair, Richard Clarida. He joins us 4 minutes away, live on TV and radio. This is Bloomberg Surveillance.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening. Buses all around you here.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
inflation cyclical, structural, to be determined, but the debate has changed, and that matters.
There's kind of still this catch-up that's happening in correcting for the COVID shock.
The economy is reopening, and the stock market is going to pivot to the next story.
There'll be numerous tests of the Fed that the Fed will have to reply to over time.
We are to some extent flying blind here. This pandemic is quite different than the financial crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. John Farrow, Lisa Abramowitz off today. You and I with the Vice Chairman of the Federal Reserve in moments. He's looking at the markets as well because these markets signal a boom economy.
Optimism, yields higher, and they've been comfortable with those high yields, consistent with a brighter outlook. The debate really kicks off next week, Tom. Inflation in America, Tuesday, the CPI print, and we're going to start to see that build. Is it just a head fake? Is it just transitory? How will we know? And I think that's the conversation we've got to have in just a moment, Tom.
We go off 1 million jobs, round it down. I'm sorry, Vice Chairman, 900,000 jobs. And then you look at James Dimon's letter and it folds into 6, 7, 8% or more GDP. And you wonder, this is original Federal Reserve policy for the rest of the year.
It is, Tom, but something's changed. Something has changed, and I think we need to reflect on that. We have gone from a forecast-based Federal Reserve for years, and now it's an outcome-based Federal Reserve. And that's a switch, a big switch. And I think only just now, in the last couple of months, has that really started to resonate with people, just how much has changed at this Federal Reserve under Chair Powell and the Vice Chair Clarida in the last couple of years.
That frames my first question to the Vice Chairman. Let's look at the market here before we get to a good conversation with Richard Clarida. John, let me take equities very simply here. NASDAQ leading through the week, maybe a pause, red and green on the screen, but S&P futures up. And John Farrow, the VIX, 16.94.
Yeah, TK, I'll take the bond market. Yields are higher by 5 basis points, 167 on 10s. That's the story of the session. Story of the month is stability. Stability in treasuries. We've started to calm down in and around your average 165 on 10s over the last month. And I think that stability, Tom, has been important to that snapback that we've seen in the NASDAQ over the last several weeks too.
Let's get right to it right now. He is the Vice Chairman of the Federal Reserve System, Richard Clarida, of course, of Columbia University, and truly one of our noted academics on monetary policy, assisting Jerome Powell at every step of the way. Vice Chairman John Farrow and Tom Keene, good morning to you.
Good morning.
I look, Richard Clarida, at where we are, and I want to go back to your important paper, The Science of Monetary Policy, with Galli and Gertler of years ago. And you lead with a quote from another vice chairman, Alan Blinder, who talks about the practicing of the dark art. Give us the state of the practicing of the dark art of the Fed, given this original moment in American history.
Well, thank you, Tom. And as Alan and we all, and I've certainly believed there's as much or probably much more art than science in monetary policy, but it's good to refer to some of that as well. I think that the Federal Reserve in August adopted a new framework. It's an evolution, but it's a robust evolution. And primarily it is outcome based. Our goals are maximum employment and price stability. And we want our policy to be robust if our models break down. And we can still do monetary policy, but we're going to be more outcome-based and less outlook-based. And I think that served us well in the pandemic, and I think it will serve us well in the years ahead.
Could you characterize that as a commitment to being late instead of being early?
Well, what we've said in September of last year, following our framework announcement in August, is that we do not expect to lift off until a three-condition are met. First, that inflation actually gets to 2%. We want to see actual inflation for at least a year at 2%, and we want that to be sustained, not just one and done. Secondly, we want to be looking at labor market indicators that are consistent with a fully employed economy. And third, we want that to be sustained. We think that's appropriate since we've hit the effective lower bound. Inflation's been below our target for most of the last 10 years. And under those circumstances, that is a good policy. You are correct that in the past, the Fed was more preemptive. And indeed, my research suggested that if you've got good models, you want to be preemptive. But if the models are not serving you well, you're more robust if you're looking at actual data. So that's the way I characterize it, Josh.
The conversation, as you know, Vice Chair Clarida, right now is over what substantial progress actually is. You're familiar with the debate. We talk about it almost every single day on programs like this. Do you think it's necessary to define what substantial progress actually is?
Well, first of all, it's actual progress. I think that's an important point. It's not projected progress. It's hard numbers on the labor market and on prices. That's the first point. Secondly, you know, we're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that. As Chair Powell has indicated, and I've indicated, as we go through the year, as the data comes in, as we release our SEP projections based on that incoming data, we will have a sense on where we are relative to that progress. And as Chair Powell has also indicated, as we think we are making that progress, we will communicate that to people who listen to our communication. And so I think that this is really where we want to be. It's actual progress. It's not projected progress. And as we go through the year, we will be informing the public about our views on that progress.
So, Rich, let's talk about it right now. You've talked about the conditions needed for liftoff, but we haven't really defined them. Conditions consistent with full employment. I don't know what that is. I've no idea if you'll tell me. We're talking about substantial progress, but it needs to be actual, not forecast. But I still don't know what progress actually is. So you don't plan to define what substantial further progress is. You've promised to give markets warning before changing policy. How exactly do you plan to do that?
Well, certainly we have 8 meetings a year. The chair does a press conference at each of those meetings. We release a summary of economic projections at 4 of those meetings. And so we will have ample opportunity. And again, the chair would not have been making those comments publicly if he was not committed to it. So we'll have many opportunities as the actual data comes in to inform Fed observers about our assessment of, are we making that progress?
Vice Chairman, the critics, and as you know, there are many critics, they have a habit of coming out Friday for weekend consumption, have a true fear of inflation. Your Andrea Aiello, running your research for monetary affairs, has a fabulous phrase of the core and the crust, looking at core inflation, looking at the dynamics of energy. It gets to the visceral fear that our radio and TV listeners have. Are you afraid of inflation? Should we fear inflation?
Well, the reality is we have a dual mandate, and half of that is price stability. And so the Federal Reserve, every Federal Reserve since Paul Volcker's leadership has been committed to that. The Powell Fed is too. But Tom, 2% as a ceiling, which is in effect the way many thought of our prior policy, also does not serve the economy well. It has, in fact, serious implications for the labor market and prosperity. And so essentially what we've said is that we want inflation outcomes that keep inflation expectations anchored at 2%. And that's going to mean sometimes we'll be above 2 and sometimes we'll be below. We focus on inflation expectations intensely. We have a new index of common inflation expectations. I would say, and we've indicated, Tom, that because of the nature of the pandemic shock a year ago, as we move through 2021 on a year-over-year basis, headline inflation is going to likely move above 2% because we're going to be comparing this year's prices with last year's collapsing prices. But we expect in our baseline most of that to be transitory and for inflation to return later this year to around 2%. That's our baseline. Let me also say that around the baseline, there are risks on both sides. And in the risk case in which inflation were to begin to move above a level consistent with price stability, we would have the tools to address that, and I'm confident that we would under that risk scenario.
Fold in the balance sheet, and that can be the twin deficits, a comparison of the fiscal situation to GDP, and of course trade dynamics as well. What do we do with the 6 standard deviation move in the twin deficit out, say, 2 years? Are you optimistic we can stabilize that terrible trend? Are you optimistic that we can somehow revert to a better outcome?
Well, you are correct, Tom, and I think this was pointed out in the IMF World Bank meetings this week, that because the U.S., for a variety of reasons, including better progress on vaccination and very robust policy support, is going to be growing rapidly this year compared to other countries. And what we tend to see historically is that when the U.S. grows faster than most of the rest of the world, some of that spills into our imports and we have a bigger trade deficit. From the point of view of the rest of the world, that's a good thing, that we're more of a locomotive than caboose. And so I would expect the current account deficit to widen this year and next under the baseline scenario. It's not something now that is a concern because capital flows into the U.S. in part because of our rates relative to the rest of the world. So no, it's not a concern. Obviously, any circumstance with a big imbalance can become a concern, but it's not a concern now to me.
Our colleague and good friend Michael McKee reached out earlier this morning, Rich, and indicated that Laurie Logan, who I'm sure you're familiar with, of course, over at the New York Fed, suggested last night that they'll be changing the composition of its QE purchases to match the outstanding U.S. debt profile. Can you elaborate a little bit on the objectives behind that, Rich?
Sure, and Laurie is a fine colleague and has done a fabulous job in my 3 years at the board, so I'm lucky to be able to work with her. What Laurie said in those remarks is essentially restating what has been our policy for some time now, which is that as we're purchasing Treasury securities, we're doing so in the secondary market, and we'd like those purchases to roughly match the outstanding the supply of treasuries in the market according to different maturities. And so, you know, as the Treasury changes its issuance patterns, then we would, of course, adapt our program to match those outstanding. So I don't think she was really trying to make news there. It's really just articulating what our policy has been for some time.
You wouldn't characterize this as Operation Twist then?
I would not characterize it as Operation Twist.
Michael McKee will be happy that we addressed that particular question, sir.
John, I just think, John, that was on the edge of rude, just so you know.
Well, I had to bring it up. Earlier on in the conversation, Rich, you mentioned transitory, and we've been playing the drinking game transitory. Every time the vice chairman, yourself, speaks, every time the chairman speaks, transitory, transitory, transitory. So here's my question, Rich. As the year progresses, how will you know if you're wrong, that it's not just transitory? How will you know if you're wrong?
Well, the simplest answer is that if inflation at the end of the year has not declined from where it is in the middle of the year, that'll be some good evidence. I also think that, you know, we look at both headline and core measures. And let me also say, John, because not surprisingly, it's a good question. This show tends to ask good questions.
Oh, thank you.
Sometimes not always, but I would say that an important point to note, and I've made this point several times, so let me repeat it.
Sure.
There is a lot of pent-up demand in the economy. We have a lot of fiscal support. You know, monetary policy's been all in for 13 months, but there's a lot of pent-up supply in the economy. 8.5 million jobs short of where we were 13 months ago. A lot of small businesses shut down. And so we do think the economy is going to reopen. So both supply and demand will be in play. And there could be some temporary imbalances in certain sectors, so-called bottleneck effects. But again, we would expect those to be transitory. And as the year progresses and as we go into next year, if they're not, then we'll have to take that into account, certainly.
So, Rich, that was the point.
I should say, John, I should also say
Please do.
that I should also say that I consult my Bloomberg regularly, and one of my favorite screens is ECFC, where you accumulate all the individual forecasts for the economy, and your entire Bloomberg panel shows a similar projection. Now, again, forecasting is hard. That's why we do it a lot. But the baseline view, even given the fiscal package, is that most of the move above 2% inflation we see this spring should revert back later this year.
I'm looking at ECFC right now, 2.1% 21, 2% 22, 2% 23. You mentioned something important though, Rich, and it wasn't lost on me. You talked about that turn from 21 into 22. Is that the ultimate test for you, that you won't really know until we get a little bit deeper into early 22, to draw that distinction between whether something is transitory or perhaps a little bit more persistent?
Well, sure. I think I just think as time goes on, you learn more about how the economy is going to adapt. I think I heard some sound. You must have had my good friend Ken Rogoff on at one point, and I think Ken, as usual, brings up an excellent observation, which is that this is a very unusual shock. A global shutdown, a shutdown of the global economy through a truly exogenous event, I think has never happened in my professional career because it impacted both supply and demand. So we're going to be learning as sectors come back online, and I'm sure there'll be surprises along the way, and we need to be attuned and attentive to the data flow. But yes, of course, and also, John, yes, we welcome the 900,000 plus jobs that are gained, but there's still a hole in the labor market, and we'll begin to get a better sense as we go through this calendar year about how rapid that progress is and how that is showing up in other indicators of the labor market. So, of course, I think, yeah.
Vice Chairman, a final question, if we could. We did speak with Kenneth Rogoff of Harvard today, and he traced the path in our academics back to Dr. Mundell, Robert Mundell, passing at 88 this week. Richard Clarida, you had the privilege of not only reading Mundell and doing Mundell, but working with Mundell at Columbia University. Your thoughts on what he gave to Kenneth Rogoff, Richard Clarida, and the rest of us?
Well, I was very saddened when I heard the news this week. Bob was a mentor and a friend for 30 years. It was one of the thrills of my career to be a colleague of his, because as a global all global and macro economists today are either students of Mundell or students of Mundell in one way or the other. And that was certainly true with me. He's truly the father of the euro. Expansive, creative, a wonderful gentleman, and really one of the great economists of the second half of the 20th century. Will be sorely missed both as a human being and as a scholar.
And I think everyone here at Bloomberg Surveillance and a team across the Bloomberg universe echo those comments. Hey, Rich, always great to catch up with you, sir. I think we're all looking forward to just getting into the same room again, and I look forward to doing that soon, maybe later this year down in D.C. Richard Clarida, Vice Chair of the Federal Reserve. Tom, that's where the debate is right now, and that debate, that conversation we've just had, more fuel gets added to that debate in the weeks and months to come.
The debate is there's no question about it. And what's interesting here is it's going to be formulated in the press conferences here, including April 28th. Michael McKee joins us now, running all of our economic and policy coverage. Mike, not only what did you learn there, but how does it change the cards, the pressure for Jerome Powell April 28th?
I think it helps relieve some of the pressure. I mean, you guys did such a great job. I may not even ask a question.
Just play it loop for I like
yeah,
that.
Exactly. Just play your loop.
Continue.
The thing that struck me as Rich was talking is the confidence with which he and Jay Powell yesterday and in his previous comments speak about being able to contain inflation if it goes up. And that enables them to let the economy run hot. Now, he didn't give you any specifics. John, you really beat on him for it, and he didn't unfortunately get it, which is by design. They don't want the markets to have a checkpoint where they say, yeah, this is the point at which they are going to do this. And so they're delivering this message over and over and over again with supreme confidence, and that has begun to sink into the bond market. You can see how yields have stabilized. They're believing that the Fed has the credibility here.
Well, I think I had this conversation, we all did, with Tom Porcelli of RBC earlier, Mike. There's a frustration from the Fed watchers that they don't have the detail they demand. But as you say, it's a feature, not a bug. And at the moment, the market seems to be on the same page. The economists seem to be on the same page. The vice chairman brought up the ECFC function on the Bloomberg. As things go forward, though, Mike, and I thought what was interesting about this conversation is he mentioned the end of 21 into 22. Whether that was almost the marker to really define whether what we're about to see is transitory or whether it will persist. And that just means, Mike, this debate is going to go on through the whole of 2021 and doesn't get resolved anytime soon.
It may bleed over into 2022, depending on the inflation dynamics. And there are 18 members of the Fed, and each one of them is going to be speaking about this on a regular basis. It's going to keep this debate alive, even if it doesn't necessarily move forward.
Mike, very quickly, we're going to run out of time, but I've really got to ask this. To me, the arch issue through 2021 is goods inflation. We have enjoyed goods disinflation, even outright deflation at times. Does Clarida and the others assume that good luck has disappeared and we will have goods inflation?
I don't know if they say it's good luck. It is a supply problem with the pandemic and the other issues we've seen in the shipping world. And as he said, there's a lot of slack out there that has to be absorbed. But that's on the labor side. The other side is a shortage of goods for people to buy, and that should push inflation up. The issue is, does that push up inflation in your mind? inflation expectations do people start to think prices are going to keep going up?
John, they're playing with our mind.
They are. It's exhausting.
Hat time.
Mike, it's going to catch up. Michael McKee there on the latest, following our conversation with the Vice Chairman of the Federal Reserve, Rich Clarida. Much more from that conversation a little bit later. We'll bring you the clips, the full interview on Bloomberg TV, Bloomberg Radio, and, of course, on the Bloomberg Terminal and on Bloomberg.com. In the equity market right now, record highs on the S&P 500. Futures up 3. We had a 0.1% to the S&P. From New York on TV and radio, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Some sad breaking news this morning. He was known for his gruff public persona and for helping modernize the British monarchy. Prince Philip, the husband of Queen Elizabeth, died today at Windsor Castle. He was 99. Philip was a penniless Greek royal who married Elizabeth in 1947. While he had no official role, he became viewed as one of the most influential members of the royal family. Philip always walked a step behind the Queen at the thousands of public events they attended. On their 50th wedding anniversary, she said Philip had been her strength. Most coronavirus vaccines are going to the wealthiest countries. So far, 40% of the COVID vaccines administered globally have gone to people in 27 wealthy nations. That represents 11% of the population. That's according to the Bloomberg Vaccine Tracker. Countries making up the least wealthy 11% have gotten just 1.6% of the vaccines. In other words, countries with the highest incomes are vaccinating 25 times faster than those with the lowest. And more fallout from the Archegos Capital blow-up. Bloomberg has learned that Credit Suisse is planning a sweeping overhaul of the hedge fund business at the center of the collapse. The Swiss bank may make significant cuts to its prime brokerage arm in the coming months. Credit Suisse has already moved to tighten financing terms with some funds. And another problem for the Boeing 737 MAX. The company has identified a potential electrical issue on some of the planes. It's alerted 16 customers they should ground the jets until the problem is resolved. The issue is not related to the nearly 2-year grounding of the 737 MAX after 2 fatal crashes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramovich back with us on Monday, 8 minutes away from PPI data in America. Michael McKee will break that down in just a moment, Tom.
Very good. Right now, we're going to squeeze this in. Tina Fordham with us, and it's constrained because of our conversation with the Vice Chairman, with Evan Hurst. Tina, we want to get this in, and I really want to get you back next week to advance on this further. We go into this weekend with instabilities in Europe, including in eastern Ukraine, including here, including there. It's an uneasy time that I would suggest has been underreported. Why do we need to focus on the international relations of Europe this weekend?
Well, I mean, there's so much good news, and I've been watching the program this morning, so much genuine basis for enthusiasm about market outperformance, about economic forecasts being upgraded. But it's also an excellent time for opportunists to take advantage of governments being distracted elsewhere. Yep. The mobilizing in eastern Ukraine is real. I don't think it will lead to conflict. But there are so many things happening that would have been front of mind, that I would have been talking to you guys about regularly, that are just getting swept under the rug because, frankly, we're coming out of this pandemic tunnel. But as you know, with the way that I work, I'm always monitoring the horizon for things that could disrupt markets, and there are a lot of things.
Well said. I've got time for one more question, Tina. We will have you back next week as this unfolds. Where does NATO sit right now as you monitor the horizon of the future NATO? Is NATO a force that can push up against Russia?
Not in Ukraine, right? So we're kind of going back to 2014 and the Crimea annexation. The tactics that Russia is using are probably what's called coercive diplomacy, but it's a geopolitical test for Biden and for Europe. And it's a great time to grab a bit of territory if you are that way inclined. More sanctions is the most likely thing, but no NATO response for adventurism in eastern Ukraine. More acutely, though, might be tensions between Greece and Turkey, both of whom are NATO members.
Tina, always good to hear from you, and always too short. Let's do this again sometime soon. Tina Fordham there, Avon Hurst, head of global political strategy. Tom, I'm not sure who put together the lineup today, but coming up on the program is a guy from UBS that you might have heard of. You heard of this guy, Luke Cower? UBS Asset Management, Asset Allocation Strategist, Luke Cower.
Untested, and we'll have to see.
We'll test him in just a moment. I'm looking forward to that conversation.
I don't know. I think he's worthy of a substantial tease.
Is he? Do we give him a tease, and then how long's the conversation with him? 5 minutes, 6, 7.
We can truncate it.
8. Looking forward to that. Luke Cower joining us on Bloomberg TV and radio.
Okay,
I think he used to work here once upon a time. And I'm looking forward to catching up with him in a couple of minutes.
What's amazing is Axel Weber will be watching.
Axel Weber will be watching. Michael McKee will be breaking down the economic data in about 5 minutes too. Tom, I'm going to whip through the price action, just get everyone set up for the opening bell in about an hour from now. Equities are doing okay. All-time highs on the S&P 500. Big week for the NASDAQ coming into Friday's session, up 3% on the week. Down on the session just a little bit. We're off by about 38 points on NASDAQ 100 futures. Interesting to see the stability of the last month in treasuries replaced by a little bit of a sell-off this Friday. Yields are higher by 5 basis points on 10s to 167.27. Euro dollar a little bit negative here too. Euro dollar down to 118.75. From New York City, heard on Bloomberg Radio, seen on Bloomberg Television, this is Bloomberg Surveillance.
Join Politics ist ein überparteiliches Startup, das nach politischen Talenten sucht und sie fördert, um Lösungen für die großen Fragen unserer Zeit zu entwickeln und diese auch politisch umzusetzen. Wir glauben, dass die Förderung von politischen Talenten und guten Ideen wichtiger ist denn je zuvor. Wir sehen auf allen extremen Enden laute Stimmen, die polarisieren und die Menschen auseinanderbringen. Und wir wollen die Personen fördern, die wirklich konkrete Lösungen entwickeln und für die Mehrheit der Gesellschaft einen Weg aufzeigen in eine positive Zukunft.
Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
About 10 seconds away from economic data in the United States of America from New York City this morning. Good morning for our audience worldwide, live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramovitz back with us on a Monday. In your equity markets, 60 minutes away from the opening bell, equities doing okay on the S&P 500, stable, unchanged, all-time highs. In the bond market, yields are up by 5 basis points on 10s to 167 and now approaching almost 167.1. Tom Keene, just a little lift in yields over the last hour or so, a real pickup again over the last morning after some real stability over the last month. We're waiting that economic data. Michael McKee's back with us for a little bit more. Mike, this is PPI. It comes out in a second, and then CPI next week.
Yeah, and CPI, the one everybody's going to be watching, but PPI, while it doesn't correlate directly, does give us an idea of the direction of inflation. And I can give you an idea of the direction of Wall Street. I don't know whether this is because everybody's clicking at once or whether it's a supply-side issue because of the pandemic, but the BLS website appears to be down, and we do not have the numbers yet.
So we get to make them up? Is that what it means?
The website says the BLS website is busy. Refresh the page and try again. And I know that our web scrapers are working on it.
This is great, Mike. Let's take advantage of this. We have CPI, which everyone knows. There are 3 kinds of PPI inflation within the business process. Which matters now within a boom economy?
Well, what we're looking for is the way it builds. You start with the raw materials. The headline number is finished goods. But if we're seeing raw materials rise, which we know we are, commodity prices have gone up, then does that feed into each step of the way, or is a lot of that absorbed, and then by the time it moves from the factory gate to the consumer is more absorbed? And that's generally the process.
I mean, I look at PPI here, and again, we await this information, and there is that fear out there that we addressed with the vice chairman, but we're nowhere near 60s or 70s CPI, or when You're in My World stopped for PPI. We're nowhere near that dynamic now, are we?
No, we're not. We may be by the end of the year, only because, as the vice chairman said with you guys, the issue is it transitory or does it keep going?
Transitory. John, stop, please.
Drinking game. There you go. I said it. And so everybody's going to be watching the monthly inflation data in a way we haven't watched it in years and years and years.
I look at the inflation dynamic, and again, we're going to talk to Luke Howe of UBS about this in a moment. We touched on it with you, is the whole mystery of the goods dynamic. If there is a commodity boom, if we see China with 8% IMF listed GDP, is that finally the goods inflation that people really fear that has not been there for X number of years?
Well, we buy a lot of stuff from China, and China's PPI was up today 4.4%, and that's a significant increase, and that part of that will come in through import prices, and part of it will feed into CPI because we do have a strong preference for Chinese-made goods. The issue is how much and for how long.
Mike, stick with us. We're going to get this economic data, no doubt, at some point this morning, and when we do, we'll turn to you, Mike. CPI coming out on April 13th. I believe that is Tuesday. The year-on-year figure, this is going to be the number. It has a 2 handle. That's the median estimate, 2.5% from 1.7% previously, and that really sets us up for the debate, Tom, for the months still to come as the base effects start to kick in.
Well, yeah, it's a basic, I agree with that, and it's going to be on the labor economy as well. And I'm going to go back, John. I'm sorry, it is about 7 million jobs to be formed here, unless that's the best guess that we see forward over the last number of months. Right now, joining us, Luke Howe, UBS Asset Management, their strategist, and I should point out formally with Bloomberg, we're thrilled that he could join us today. Luke, you do mention in your research note the goods producing economy. UBS has a terrific reach, particularly across the Pacific Rim. What do you see in the dynamics of the goods-producing economy?
Well, I think what we highlight and what we're excited about, it informs a lot of our positioning, is the breadth of the strength in goods sectors. So if you look at just the share of 25 major economies that we track, where your ISM manufacturing is both above 50 and accelerating on a 3-month basis, that's well elevated, well over 3/4 there. And then when you're looking more at the internals and you're seeing both new orders up, backlogs of works up, customer inventories down, that just screams. That's the recipe for future production growth. So that gives us a lot of confidence that this pro-cyclical trade, both in equities and in currencies, does have a lot of room left to run as the year progresses.
That's what gets my attention from some of the notes you gave us ahead of this interview, Luke, is that you want to stick with it. Can you walk me through the sticking with it of the moment after a huge rally of the last 6 months and having the confidence and just the willingness to do exactly that and how difficult it might be?
So the sticking with it does entail a bit of kind of adapting and going to areas where it's still going to be early cycle and changing the nature of how and how much risk you want to take. So in terms of just broad equity market beta, of which the US is obviously a great part, that means maybe dialing that down and focusing more on both relative value trades that are much more procyclically exposed. So your Japan and Europe versus world, your value stocks, and also then kind of focusing within foreign exchange, a lot of areas where you do think that there is kind of more bounce back, where the US services sector assumed recovery. I would argue there's very lofty, mature expectations baked in there, whereas in other segments, it's just completely sentiment still quite washed out, quite a lot of room to run there. So that's looking at Europe and emerging markets, and in particular EMFX.
Where the bar is super low. How do you want to play Europe, Luke?
So through Europe, one way is just through a broad basket of European currencies. I think it's been interesting over the past couple weeks when you look at, you've had some bad negative Europe-related both vaccine and lockdown announcements. Go to those days, play a game of when did that headline hit? Where do you see it in your USD? You don't. So that's a good sign that, along with U.S. data not really offering as much of a lift to the dollar and yields as it has in the weeks past, that's a good sign that the degree of pessimism towards Europe is pretty thoroughly baked in, and that you're kind of primed for a bounce back there. Another interesting thing there is that European economic growth and relative profit growth versus the U.S. don't necessarily have to correlate, and that's just due to the cyclical orientation of the index. So although we expect, just because of stimulus, U.S. growth to be far superior to Europe this year, that doesn't necessarily entail slower European profit growth. So that's both through playing the more cyclical areas of Europe, like Italy and banks, and it's also focusing on the currency.
Lukawa, tell us the character of dollar weakness. I mean, is it a dollar weakness to trend or to edge of range, or is there a vector here of significant dollar weakness in your call?
So something that we can focus on in looking at the dollar turn, I think you had my boss, Evan Brown, on several months ago after the Georgia election saying, hey, you have to kind of refocus and rethink how broad a U.S. dollar decline can be in an environment where we're going to get all this fiscal stimulus. And that's something that's obviously worked well, been reflected well in our positioning. However, going forward, the way I'm kind of thinking about the kind of factors that will lend itself to U.S. dollar weakness broadly, it comes from the Federal Reserve and the global outlook. So right now, if you look at front-end euro dollars, so anything kind of below mid-2023, you can kind of think of them as an option. On the one hand, they're pricing in all this risk premium, all this hike premium, because of how much fiscal stimulus we have and how good the economic data has been. On the other hand, you have folks like Rich Clarida, you have the Fed consistently saying, hey, we're going to be patient. We see this global growth pick up just like you do. We don't see it necessarily hitting inflation. And yet those kind of euro dollar options aren't exhibiting any kind of time decay that you would expect from the Fed continuing to reiterate its forecast about strong growth doesn't mean higher short-term policy rates. So it's that kind of give and take. The release valve through that we think will be the dollar, because we priced in so much in that front end, and it really can't go too much further. At the same time that you're starting to have vaccinations in Europe pick up and a little more breadth to that service sector recovery. So that's what induces a lot of asymmetry to the short dollar trade right now.
Is cash of value to you now? It's been a debate here for the last 3 or 4 days. Is it a traditional, mutual fund type 3-4% cash, or can you really build up cash to be opportunistic?
Well, I will say carry on a relative basis slightly is preferred. Slightly when you're looking at whether you're dialing up relative equity market beta or carry based just on the equity rally we've had, kind of pushes you a little more towards carry on that front, whether it's through US high yield or emerging market dollar debt. So that's something to think about. But in terms of cash, sitting in cash with a economic backdrop as strong as we have, it doesn't seem like the kind of most prudent course of action when you have carry available and when you have relative value trades that do still have a lot of leverage, the good cycle of recovery and just the broadening cyclical strength.
And John, what's so important here is we're waiting and waiting and waiting to see that dollar reversal. I mean, it hasn't. It's sort of, John, it's like the Toronto Maple Leafs who haven't won since 1967.
I recognize the voice. Isn't he familiar?
Yeah.
Tom, this guest. Definitely seen it before.
We're waiting. We're just waiting.
How are the Maple Leafs? Is it the Maple Leafs?
Yes.
Is that right? How are the Maple Leafs, Luke? How are they doing?
This is the great part here, because we've been waiting since, I'd say,
Mr. Brown is teaching you well.
We're heralding big turns here.
Hey, Luke, it's been way too long.
Nice
it's good to see you. And it's great to see the success you're having too over at UBS. Luke Cower, UBS Asset Management, Asset Allocation Strategist. So if you're tuning in for PPI, some of you might have been. I'm always tuning in for Michael McKee. At the bottom of the hour, 8:30 a.m. Eastern Time, we're waiting for those numbers to cross. And Mike McKee, I understand it's just refresh and please try again, refresh and please try
What's
again.
It mean?
That's it. I'm here, but the BLS is not. Under the Trump administration, they decided to get rid of the lockups where reporters were given the data in advance and were able to write stories and then send them out at an embargo time. To be fair, it also came about because of the pandemic. They didn't want to lock a whole bunch of us in a small room. But this is the downside. The computer goes down and all of Wall Street around the world doesn't have the information. PPI, not the biggest mover in the world, but you can imagine if this were Jobs Day, what kind of reaction he'd have to have.
You and I will revisit a question now that came up this past weekend, and somebody said, can you trust the data? Give us the update, and this goes to the National Association for Business Economics and our statistical veracity. Can you update us on the quality of the BLS data?
The quality of the BLS data is good. They have made an effort to let people know, that they have statistically verified the data. The only thing is the Department of Labor, which does jobless claims, that data not as accurate.
Michael McKee, on the latest data, if we get it,
was
we'll
very
bring it to you.
Very helpful.
Refresh and try again. Tom, I'm going to run. Great to catch up with you, sir.
Maple Leafs, they were
I'll see you Monday. Great to catch up with Luke Cower, with Richard Clarida. Up next on Bloomberg TV,
Lisa has a golf stream,
we'll catch up with Mohammed Al-Arian of Bloomberg Opinion, columnist, and of course Queen's College, Cambridge president. Looking forward to that conversation a little bit later from New York City this morning on TV and radio. This is Bloomberg.
With the First One News, I'm Rishika Gupta. He had no official role, but for more than 70 years, he was one of the most influential members of the British royal family. Prince Philip, the husband of Queen Elizabeth, died today at Windsor Castle. He was 99. Philip was a penniless Greek royal who married Elizabeth in 1947. He helped modernize the British royal family, and his politically incorrect statements both amused and appalled the nation at times. Michigan is grappling with a coronavirus surge that has made it the worst place for COVID in the U.S. The state reported more than 8,000 infections and 30 deaths on Wednesday. It's now on pace to surpass its December record. Meanwhile, on a per capita basis, Michigan has the most coronavirus hospital patients in the nation. The UK will decide by early next month whether Britons can resume taking international holidays on May the 17th. Countries will be rated according to their coronavirus risk with a traffic light system. It's too early to say which countries will get the green light. In Vienna, Iran's chief negotiator at the nuclear talks says the sides are now focusing on removing U.S. sanctions in a single step. The U.S. hasn't commented on that claim, and there's no word what Tehran is offering in return. So far, the U.S. has ruled out unilaterally lifting to sanctions in order to get Iran to return to the 2015 agreement on nuclear enrichment. Amazon has taken a commanding lead in a historic election. The vote will determine whether workers at an Amazon warehouse in Alabama will become the first in the U.S. to join a retail union. With about half the votes counted, Amazon is ahead by a 2-to-1 margin. The retail, wholesale, and department store union calls the system broken and says it will appeal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Ritika Gupta. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The new strain will get everywhere within 3 or 4 months. And that makes it absolutely essential that we have a global vaccine effort, a global testing effort, and this is a critical point that I've been working on. We're going to have one of these things every decade or so. And we need an infrastructure to make sure that we're constantly watching and ready to stop it at its source at the beginning.
The economist Larry Summers, of course, former Treasury Secretary, his commitment to David Weston's Wall Street Week, important comments. It has been a terrific day of economics, including Professor Rogoff, Professor Clarida, now Vice Chairman of the Federal Reserve System. And we finished strong because Rogoff and Clarida listen to the laureate Angus Deaton. I will not mince words. The gentleman from Princeton is our definitive voice on our inequalities. It is front and center for all of us in our economics and our politics. His new book is also definitive. Also, I should say, it is Francine Lacroix's Book of the Year, and we're thrilled to have Angus Deaton on with us. He looks at the despair that is out there. Professor Deaton, how bad is our inequality? What is original about our 2021 inequality?
Well, everything's different in the pandemic. So one of the things that one's most worried about inequality during the pandemic is the pandemic is affecting different people differently. And some people like you and me are staying at home and talking to each other over the web, while others are out there risking their lives. And what I'm afraid of is that these splits during COVID will exacerbate differences that were already there and were festering in America and surround the issues of deaths of despair that Ann Case and I have been writing about.
Do you believe that we have a political will to at least nudge our inequalities in a better direction?
Well, we certainly have some people, and the current administration, the Biden administration, is much more interested in doing that than the previous administration was, but it's very early days yet. The American Rescue Act certainly would help with income inequality because so much of it is targeted towards less well-off people. Whether the measures in the infrastructure plan will go through is not clear to me right now.
What do we do with our American individualism? There's a voice in America that says inequality comes from our individualistic effort. And of course, that buttresses up against those more societal, those more all-encompassing. How do we stand on our individualism, and how do we move that forward and sustain that as we try to get away from this inequality?
Well, I think the individualism is incredibly important, and I don't really think it's very much at risk, to tell you the truth. We've focused on the individualistic aspect for a very long time, and it's brought us great benefits. I mean, the wonderful benefits of modern capitalism, which have helped many. But, we've got to make sure, for those of us who've done well out of this, that other people share in that too. And one of the biggest divisions in America today, and one of the riskiest ones, is that an educated elite, people broadly who have a four-year college degree, have been doing extremely well for the last 50 years, whereas for the people without a college degree, they've seen a 50-year trend of downward wages, downward labor force participation, and, you know, we'll tear our country apart if we don't share.
Angus, what is so important here, and I believe you and I talked about this at Davos 2 years ago, and I'm going to believe nothing has changed here as well, is the impute of technology upon this debate. We try to look out 10 years or 20 years or half a century to what this profound technology means. What do you think it will mean for society?
Well, less than some people think, I think. I think this vision of a world in which there's no jobs at all and everything is done by robots is science fiction, was then, is now, and probably ever will be. There's a lot of things we can do, though, to help provide good jobs for less educated Americans, or to stop destroying good jobs for less educated Americans, like subsidizing the introduction of robots, for instance, which we're doing right now, or having a healthcare system which is gutting the labor market for less educated folks.
But I mean, Angus, what is so important here, and I'm going to go to a chapter in Deaths of Despair, which is things come apart. A huge body of our radio and TV audience believe whatever their background, whatever their wealth, maybe they're in the highest tax bracket in New York State. The fact is they look at this country and say things are coming apart. How do the elites engage this conversation given the political maelstrom of Washington?
I think it would be really good for us to talk together better than we do right now. I think it's very important for those of us who do belong to the educated elite to listen to the other people. One of the things I keep hearing people saying is, do you hear us now? And, you know, rioting at the Capitol, or, you know, voting for someone I regarded as a very destructive president are howls of protest. And perhaps those would be less severe if we'd been listening harder and a little longer and not just celebrating the undoubted triumphs of capitalism, but understanding that there's 2/3 of the population who are not benefiting very much from it, whose life expectancy is falling. Even that, which is a pretty fundamental thing, even that's falling for the last 10 years for people without a bachelor's degree.
Angus Deaton, thank you so much. The laureate from Princeton, and of course the new book, Deaths of Despair with Ann Case. We are here with a mix on the screen, just to blend it out, a red and green on the screen. I'd note the Dow with a little bit of a lift, the VIX 17.21. Michael McKee with us with Dead Silence. BLS, has this ever happened before? This is original, isn't it?
We've had problems before, but not that I can remember.
We have no data
this
yet,
long.
do we?
We don't have any PPI data
do?
yet. We're just going to have to go on with life somehow.
Without data.
Somehow without data. It does seem to be a major crash at the Bureau of Labor Statistics. Their computer website is down, and we don't have the PPI prices. There are some rumors in the market about numbers that I won't repeat because they're just rumors, but we are seeing a bit of a reaction in the bond market with yields up a little bit. So you never know what people in the markets know that we don't.
I'm going to suggest we started the week at a 170, down to 163, whatever. We were even down to 160 and now 168 on the 10-year yield as well. How far away is April 28th?
It's a couple weeks away now. That's the next.
Do they get data? Are they going to be wiser about this boom economy?
They are. We're going to get retail sales for one thing. We have a lot of housing data coming out. What we don't have, what we won't have, or they won't have, is the latest PCE data.
Right.
They'll have the CPI. And
very good.
They expect it to go up.
I just had to get my dose of McKee data in there because PPI failed us today. John Farrow and I say thank you to our team for a just first-rate day of economics, and we thank all of you worldwide and across this nation. Coming up, Jeffrey Okamoto, the IMF. This is Bloomberg. Good morning.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
It's really a reminder, isn't it, just how sensitive the markets are. Any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
And here come the higher prices from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now with 30 minutes until the open in Bell. Equity futures slightly negative. Let's get straight to it. We begin with the big issue. Is the cyclical rotation losing steam?
The momentum is with technology.
Yields have come in.
A little relief on the 10-year.
That's part of the reason why tech has worked.
We've gone from rotation to counter rotations.
We're going to see the yields stabilize.
The elixir for these stocks to snap back.
Tech's going to rally significantly.
We saw a huge rotation go into cyclicals and small caps.
The small caps have started to underperform a little bit.
We're beginning to trim back many of the reopening stocks.
The ball is in, say, tech's court.
I get the whole rotation trade.
Perhaps that rotation is slowing down.
The stock market is going to pivot to the next story.
50-bit move in the 10-year doesn't change the multi-year bullish view.
10-year bond yields are still too low for that reality.
Technology is not going away.
Technology is not going away. That's the story of the last month. The story of the session, a little bit different. Let's bring in the Bloomberg team, Abigail Doolittle and Taylor Riggs. Morning, Abby.
Hi there, John. Well, today we do have the NASDAQ 100 futures down slightly, but the month of April has been all about tech. The S&P 500 tech index up about 7% since March 31st, and more specifically, the mega cap techs. In fact, 50% of this string of record highs that we've had for the S&P 500 coming from your Apples, your Microsofts, your Amazons, and Alphabet. And while 2021 has been about small cap and value, the rally out of the March lows last year has been all about growth. If we go into the Bloomberg terminal and take a look at a great chart, we are going to see that growth, all of those green bars point to the outperformance for the growth stocks over the last year or so. We see the last 2 weeks in spades, growth is really climbing higher. Investors want back in on big tech. As for some of the names that have done exceptionally well over the last 2 weeks, a really interesting mix between Applied Materials, KLA 10 Core, Lam Research. So you have some of these semi-cap equipment names. We have this chip shortage that everybody's talking about. This is a tell on continued robust demand, also from a fundamental standpoint. So it's all about tech. And as you know, John, this also has to do with the fall, not today, but the fall more recently that we've had in yields.
Abby, thank you. I've got to say today a little bit different. Yields higher this morning, and we've got some PPI data to break as well, an upside surprise. We'll do that in just a moment. Let's cross over to Taylor Riggs on the bond market. Morning, Taylor.
Good morning, John. And the bond market has everything to do with some of the recent NASDAQ 100 outperformance. Now, year to date, you're still underperforming the S&P 500, but what a catch-up it has been, really since mid-March. And that's exactly when yields started to level out. So you've seen in orange, NASDAQ 100 trying to play catch-up to that S&P after the big underperformer for the first two and a half months of the year. We changed the board, and you see, of course, it all comes back down to yields. BMO Capital Markets saying look for the 10-year to test 150 before you see it go back up to 177. When that 10-year yield topped out at 177, you saw some buying come in. That's when the NASDAQ 100 really started to outperform the S&P 500. But you can't have a coexistence both ways. You can't have bond market volatility rising, as you see in the MOVE index in orange and an S&P volatility that is low. I would argue maybe bond markets are right. You have a steepening VIX curve, of which Abigail Doolittle is the expert, showing perhaps maybe some volatility on the horizon.
Taylor, thank you. Looking forward to hearing you continue the conversation with Romaine Bostick and Caroline Hyde a little bit later on the close. Let's get back to that data. Pause, refresh, you wait. Mike McKee, the data doesn't come, and then the BLS just puts it out on Twitter.
What would we do without Twitter? The BLS finally figuring out the 21st century and sending us the data in an alternate fashion, and it is alternate data. This is definitely the first sign of inflation that we're going to see, probably based a lot on the base effects, the big drop in inflation last year at this time. But PPI for final goods, final demand, up 1% in the month of March. That's double the estimate of 0.5%. On a year-over-year basis, that pushes us to 4.2%, and that's the highest since September of 2011. Almost 60% of that can be traced to 1.7% in advance prices for goods, which is what we have been expecting, and what Rich Clarida was telling you earlier today, John, that they expect goods demand to push up prices because there are going to be shortages. A lot of this was based on an 8.8% jump in gasoline prices, but also if you take out gasoline and food, you end up with a 0.9 rise. So there is inflation at the factory gate. It was expected, but it comes in a little higher than had been expected.
Anticipated, expected, and here it is. It starts with PPI, CPI coming up on Tuesday. Mike, thank you. And what a great time to catch up with a good friend of ours, Mohammed Al-Arian of Bloomberg Opinion and Queen's College, Cambridge. Let's start right there, Mohammed. Your response to the data that we're starting to see now in PPI, and we'll see it in CPI next Tuesday.
Yeah, and this data is going to focus attention even more on the inflation issue and even more on something you discussed with Vice Chair Clarida, which is the Federal Reserve reaction function. John, this is beyond the base effects. The base effects were reflected in consensus expectation. This is something between demand pull and cost push, and it's something to pay attention to.
Mohammed, this is so important, and you referenced that conversation with Rich a little bit earlier, the Federal Reserve Vice Chair. I asked him how they'd know if they were wrong on the transitory debate. I just want to play a little bit of this, Mohammed, and then get your response to it. Let's take a listen.
If inflation at the end of the year has not declined from where it is in the middle of the year, that'll be some good evidence. Both supply and demand will be in play, and there could be some temporary imbalances in certain sectors, so-called bottleneck effects. But again, we would expect those to be transitory, and as the year progresses and as we go into next year, if they're not, then we'll have to take that into account, certainly.
Mohammed, going into next year, let's just debate this and go through it together. The end of this year into next year, is that the real test for the transitory debate? Is that when it takes place?
For economists, yes. For the marketplace, no. And that was a great interview. Thank you very much for bringing it to us, because it was the clearest articulation I've heard of the shift in Fed policy from proactive to reactive, from model-based and forecast-based to outcome-based. And as Vice Chair Clarida clearly pointed out, it's going to take the Fed quite a while to figure out whether transitory is indeed transitory. And this is a high-risk policy scenario. I doubt we would be here if the monetary framework change had not happened before the shock we received. But now we are, and the Fed is going to have to figure out how to operate through this environment with a framework that was much better for the world of yesterday than it is for the world of today.
Well, let's talk about the world today. The world of today, their framework at the moment is still pretty vague, Mohammed. They talk about things like substantial progress without really defining what substantial progress actually is. Right now, that's a feature because economists seem to be on the same page as them, and so far the market is as well. Do you think that becomes a bug further into the year?
Well, he gave you clarity on what that means, and I wrote it down here, John. I was listening. Inflation at 2% for at least a year, the labor market at full employment, and full employment being sustainable. So they told us what they are looking at. So we have some clarity about this. I think economists and the Fed in general will remain less concerned about inflation than the markets will. And you see this today. it doesn't take much to rekindle inflation concerns in this marketplace right now.
I think what you touched on, Mohammed, is so important. It's not what economists are talking about, it's how markets respond to it. And this is data that we've been anticipating. And one question that I've been raising, and you and I have discussed it, is just how people respond to it when they actually start to see it. This is PPI. We get CPI next week. Some of it's base effects, other parts of it's not. Mohammed, how do you anticipate people will respond to this? And this, I guess, is a question not just for the economists out there or the market participants, but also for the psychologists too. How we respond to that data when we actually see it is different to how we respond as we anticipate it.
Yeah, so if conditions weren't what they are today, we would wait. We would wait to see whether this inflation is indeed transitory or not. But as Ken Rogoff pointed out in your show earlier today, the system right now is not prepared for an interest rate shock. And that's the issue, is that we have gotten used to very low interest rates, very well-behaved interest rates. Why? Because our main problem was inflation is too low. Now we're seeing a change in that paradigm. So the problem, John, is that the initial conditions are all based on very low interest rates for a very long time. And what we may get is a different outcome. And that's why the market reaction function may be very different from the economists and the Fed's reaction function.
This takes us to the really important conclusion of this conversation, Mohammed. It's where your ultimate concern lies. And it's not around the inflation debate. It's around financial stability. Can you paint the picture for us?
You know, John, we've lived in this wonderful environment for investors of ample and predictable liquidity, extremely loose financial conditions, and confidence that this paradigm will continue. It has been the most favorable liquidity paradigm that I have seen for the marketplace in my career. And it has benefited investors enormously. And when you have that, it is normal to take more risk. You are encouraged to take more risk, and there will be excessive risk-taking. We've had examples of that this year. So the concern is, if the liquidity paradigm changes, do we expose these areas of excessive risk-taking or not? And that is something that people have to keep a real close look and a close eye on, is the extent to which the system has taken more risk than what would be warranted by what's going to happen to financial conditions.
So let's finish there. I think typically, as a journalist, you're almost tempted to ask the when question. I always think the when question is kind of pointless. Let's talk about the signpost you'd look for, Mohammed, that would actually give you that concern that something sinister was just around the corner. What are those signposts?
One word: flows. Keep an eye on flows. So far, flows have been mostly in one direction, into the marketplace. If we see flows hesitate, this is a market that needs more and more flows. Look what's happened to the SPAC segment in the last few days when there's been questions about flows. So flows, just keep an eye on flows.
Mohammed, super smart and always great to get your time on a Friday morning. Great to catch up, sir. Mohammed Al-Arian there of Queen's College, Cambridge. Let's turn back to this market. Equities turning a little bit lower on the S&P 500 off the back of that higher than expected PPI data. Yields were higher going into the print. Yields are higher again now. Let's get you some movers. Here's Abby.
John, well, on that higher print, that hot PPI number and higher yields backing up, let's keep it super simple because this is, of course, helping, not surprisingly, the banks. We have a very nice rally for the banks and a bit of a reversal of what we've seen in the month of April, but all of the big banks up about 1%. However, what's hurting, what has actually done well in April until now, big tech, because those valuation concerns are coming into play. So keeping it real simple, this is what's dragging on the NASDAQ 100 the most. Apple and Microsoft lower. So again, a reversal of what we've seen in the month of April. Let's see if it continues as the day goes on.
Abby, thank you. Much more from Abigail Doolittle through the hour, counting you down to the opening bell. Up next, inflationary pressures creeping into the economic data. The Fed still unconcerned. That conversation up next with Krishna Mamani of Lafayette College. From New York City this morning, good morning. 18 minutes away from the opening bell. Futures down 4. We're negative 0.1%. Much more, as Abby says, on that hot data on PPI. And Michael McKee just around the corner. This is Bloomberg.